Anyway, good evening, guys. Welcome, everyone. Thank you so much for joining us this evening. I want to welcome you guys, and I always appreciate you guys taking time to be with us. And tonight, as you can tell, we have a very valuable, my special guest speaking tonight. I think Ray's a true market savant. I think he's a walking Markopedia. And if there's anyone or anything to know in the markets and trading, he's our go-to guy, not just to our group, but he's also a quant, and he's a quant to some of the top banks and financial institutions. So you can see I know what I'm talking about when I say that I think he's very special. Anyway, tonight, since we're going to be talking about trading, we're going to be talking about trades and profits. It's always important to know what your risk is in the market. Always know your risk before taking a trade first and foremost. So well, let's make sure we've got that out of the way, that you all know that trading's difficult and that you need to know what you're doing before you start putting real money in the markets. And Ray's going to talk about that this evening. And then we're going to talk about why are we here? What are we going to be doing here? But as I've always said, why was I saying that Ray's so valuable? Why do I say this with such confidence? Because we've been working with Ray for 5 years, and he always delivers the absolute best institutional market and trading truths to the retail trader. And one of the things you're going to hear tonight, he's not always going to tell you what you want to hear, but he's certainly going to tell you what you need to hear. And over the past 5 years, we've seen many, many traders completely transform their thinking. Now, notice I didn't say trading, although that has happened as well, but I said thinking, and this is key, and it's a critical piece that I see that is missing for most traders. It is to build a solid institutional trade narrative, to, think like an institution, and that develops confidence, consistency, and that's what's needed to achieve success as a trader. And he provides the why, you know, not just the how to trading. And we're going to really talk about that because I think that was really, really important. And after we started working with Ray, after just a few weeks, that really jumped out at me, that he was given the why, which is truly, I believe, a game changer for all traders. Because when you know why price is where it is and where it's going, and I'm sure some of you guys have taken a trade that works today, and you can relate to this, then done your same whole trade plan, and tomorrow you take that same trade, same market, everything looks the same, and it completely fails. And what happens? You're left there going, I don't know which one was wrong, because the one that was wrong could have been the one that you thought that you made the money on. So, or even what to look for. So instead you believe, and it starts becoming about you, and we know what narrative develops from that. So when we're talking about a narrative, we want to get the right narrative not only for ourselves, but for our trading, because that's what's going to develop, the knowledge that you need for markets and for your trading. And, I always have to laugh and go back to our first year because it's no wonder early on when, traders in the group would ask Ray about psychology and he would just kind of laugh and he'd say, I don't really get what the problem is, with you guys. And he would say, he was going to be about as much use as a chocolate ashtray for the psychology lesson, but he would go ahead and give one. It was going to be about 2 minutes because his point was just, learn the proper information. You learn it, you experiment with it, you get on your charts, you adapt it, then you do it again, then you work at it, you do better, and there's your class. So there you guys have had your psychology lesson from Ray. He probably will deliver it with a lot more punch, but that's basically it in a jest. So, you know, and as we all know, I don't think for anybody in here, it's not about you guys not wanting to put in the work, but here's the thing about hard work. It doesn't guarantee success, but it absolutely improves our chances. And that is what trading is probability and edges. And you have to really work, to develop, strong probability and edges. And that's what Ray's going to talk about. Many of you on here tonight know this all too well. You've spent countless hours, even years, tons of money, hard work, and you're still struggling. So you're asking yourself, why even do it? If you're saying for the money, I think some of you that were on with our traders the other day would tell you, yes, the end game is the money, but to give yourself that edge, and being willing to sacrifice and embrace the grind, love the process, you have to have absolute crazy passion for the markets. So, you can accept, the challenge that's in front of you and the setbacks because guess what? There's going to be setbacks. So we all have to embrace the grind, as I like to call it, and be really ready to embrace the markets. But one thing that I've seen over the years is Ray absolutely, I think he eats, breathes, he lives the markets, and it shows. It's why he's so elite and he's at the top of his game because why else would he be willing to be here, like right now on this webinar? It's midnight for him. So seriously, we don't believe he sleeps, but I sure appreciate him being on here. But, tonight as Ray speaks, I want you guys to really step back and think about it. What's the solution to trading, to turn your trading from gambling and guessing to, as Ray talks about all the time, it's about probabilities. And with him being a quant, that's what he's developing is probability and edges. So he really teaches you to look at the market quite different. So now you know why I'm so excited to that when we get to hold a session with Ray, we actually don't hold them very often. I think the last one we did was last summer. And so if you're new to us, Ray's a quant. He's a trade model bank strategist, and he's learned how tough it is over the last few years for retail traders. I think he was absolutely shocked and appalled when he met us 5 years ago. He was actually, when we met, it wasn't about him teaching traders, so we'll get into that story a little later. But, he was pretty shocked at how little we actually knew. And after our initial conversation, I was so intimidated, clueless, and really a bit embarrassed, to be perfectly honest, because, as currency traders, which was mainly the market we always focused on, we were not thinking about how the markets actually operate, what's driving the market, the why, the difference between commercial activity and the role of the market maker, and how all of that affected our trading. And we sure were not thinking about how important it was to understand value and yields and all of those good things. And here was Ray's question, why not? So it's a pretty good question, and it's kind of how we're going to start the session tonight. So be ready to take some good notes. Look to see how the market, look at the market from the view that Ray's laying it out from the mind of a quant, because he sees it completely different. So I think you may be able to pick up some things, but I don't want to keep you guys because you're here to hear Ray. So Ray, if you're ready, let's get started.
Have you done all the disclaimer, Kim, have you? We'll be looking at some
Yes,
actual results.
Yep.
You have?
Yep.
Alrighty.
I've already told them that, they're going to lose all their money and all of that good stuff. So hit it.
Hey, hold on a second, guys, and I'll just get the screens.
Goodness, Ray's getting set up. Thanks, guys, for being here with us. If you weren't here at our opening, thanks for attending.
Is the screen visible, Kim?
Absolutely.
Alrighty, we're ready to rock and roll then. Good. why traders fail. Why are we starting with this depressing subject? Why are we starting with this depressing subject, guys? Why do traders fail? Because most people are here because they haven't got the success that they've maybe perhaps wanted or expected from trading, and as a result, you're here. You know, a lot of the guys are here because they're ex or current clients as well, and they're just here for support and because they're pretty much bored doing anything else at the moment. So why the hell not? Why do traders fail? Well, interesting little quote from a chap called Willink, the chappie in the bottom right-hand corner, Navy SEAL. The consistent attribute that made them great was that they took absolute ownership, not just of those things that they were responsible, but for everything that impacted their mission. This is from a book called Extreme Ownership, How US Navy SEALs Lead and Win. And why did I start with that? Because the biggest challenge I've seen with a lot of retail traders is excuses. Every retail trader that we come across seems to have an excuse of some description or another. They never have ownership of anything. They have an excuse complex because, well, it was that guy's course, or it was this never worked for me, and it was never that. Never, you know, the indicator didn't work, the EA didn't work, the program didn't work. I enrolled in it and it didn't work for me, so there's always an excuse. There's always something passed on to somebody else, and it's that ownership that people don't take. And when we see people actually taking ownership of the process, and that's what's different about what we're going to be talking about against pretty much everybody else, is this concept of ownership. You guys are here because you want to take ownership, I'm sure, of your own trading, not because you want to be a follower of one system or a follower of another system, but you want to actually finish off being a trader that can get a job at Goldman's if you decided to turn up and go through their interview process. That's the kind of trader you want to be, I'm sure. Not an order book trader, not a specific trader, but somebody that can actually walk into any situation under any condition and say, you know what, I can do this. I can actually hold my own in this environment. And that's what's important. And I can feel your pain from this. I can feel your pain from this process because, you know, why do traders fail sounds like an awful negative start to a whole trade idea. But when we see what I get, for example, since I started in this space, I started to look around the space that you guys are in. I started to ask the questions, what's available, what do you guys cover? And I'll show you what happened in terms of this process. This is 1 day of email headlines. This is 1 day of email headlines, of banner headlines that I've had in my email box today. Now, I'm not making any comments whatsoever about the individual offerings that are contained in these emails. I've tried to make sure that I've cut out everybody's names or offers or whatever they are, you know, because they might well be brilliant offers. They might well be brilliant offers. But you can see here, big picture, 4 costly errors to avoid during March Madness, how to make $6,200 off of $300 in 10 days. We've published a new blog on our website. What does the VIX tell us? Cloud gaming is poised to shake up the video game industry. A tidal wave of revenues and profits in the cannabis industry. If you're only going to select 5 income trades, well, you can see, I'm not going to go through them all. So I can feel your pain on this. This is one of those things that you look at it and you say, well, which ones are actually any good? Which ones are actually going to give me what I'm looking for? Well, that's a big, huge question, isn't it? Because what is it you're actually looking for? Because a lot of you don't really know, because you know, when you come into trading, you haven't had any experience. You've maybe never known an actual bank trader. You might have known somebody that's worked in a bank. You've maybe known somebody that's perhaps been an order book trader, or somebody that maybe takes orders for large institutions, or for, you know, maybe a market maker, maybe an old ex-pit trader. Completely different to what you guys are actually trying to achieve with your own trading. So you've got to be careful. There's lots and lots of traders out there. Ex-floor traders, they're not going to be very good for you because their style of trading isn't going to be any use to you. Their information might be interesting, but it's not going to be of any use to you as a retail trader looking at different time frames, different charts. You've got to be very careful. Market makers are no use to you either. Market maker information isn't an awful lot of use to you. You've got to know about it, but it's a very, very difficult thing to kind of get your head around. You've got to try and separate yourself out from some of these ideas. I want to be this, I want to be that. So I can feel your pain, guys. Which one of these offers are you going to take up next? Are you going to buy the best gold asset to own right now? Are you going to take the best scalp trade in the market? Are you going to become the next swing trader on this video game industry? Are you going to buy lots and lots and lots of cannabis stocks? Whatever takes your fancy. So what are we going to be looking at? Well, we're going to look at some of the reasons why traders fail. We've just looked at some of the reasons why traders fail. They get so many offers of help from this avenue or that avenue, they sit looking at it saying, I don't have a clue where I'm supposed to go with this. I've just spent $200 on this newsletter. I've spent another $1,000 on that course. I don't know where I'm supposed to go next. I don't know. I'm end of my tether, end of my account. My partner is telling me no more. Either get going with this thing or give it up. Key reasons why traders fail. They try to trade like commercial traders, but don't know what commercial traders do. I mean, do you know what a commercial trader does? Do you even know the definition of a commercial trader in terms of things like the COT? Perhaps you do. So do you want to trade like a commercial trader? Well, good luck with that one. A lot of traders in the retail space think that it's easy as pressing a buy button or a sell button. It's not. It's not as easy as pressing a buy button and a sell button, because obviously that's the last part of any process. That should be the easiest part. The definition of a good trader is somebody that presses their buy button or the sell button without hesitation, because the analysis has already been finished. Your trade plan's already there, and now your job is just to execute. They think that by passing the decision off to so-called algorithms or indicators or EAs, in the olden days it used to be called EAs, or robots, that they're trading. By passing off your information, by passing off your trade decision to some sort of indicator or some sort of algorithm or some sort of other process, that's not trading. That's the same as just hiring somebody to press buttons for you. You don't know why the trade's getting taken place. You don't know what's going to happen if it starts going wrong, which it normally does. And therefore, it's not trading. It's just you're giving over the management to something else or someone else. They think that they want to trade like market makers. But again, they don't know what a market maker does. I've heard an awful lot of bullshit about market makers. The market maker drives the market here. The market maker drives the market there. The market maker's massively bullish. The market maker is massively bearish. Nope, that's wrong as well. They think price will revert back from some overbought or oversold pattern. Why? Because it's overbought or oversold. How do you know it's overbought or oversold? Have you never seen a trending market before? Of course you have. It doesn't always rotate around a 0 point, does it? Stochastics do. They rotate back and forward, and it makes this orderly market look very, very simple. And it's not, because you've all probably tried it. Retail traders think patterns mean something. Well, here's the problem. Sometimes they do, but which ones? And which ones don't mean anything? Well, guess what? The same pattern can mean two different things at different times in a marketplace. Is a rising wedge bullish, or is it bearish? It's neither. Or it's both. It could be bullish and bearish. It could be neither of those two things. So what's the point of having it? What's the point of knowing about it? Because when you know how to apply a rising wedge or a pennant pattern or a head and shoulders top or bottom, you can actually make some sort of contextual decisions based upon some other elements that are coming into the market. It's not the pattern that's important. It's what the pattern can actually give you in terms of trade opportunities that's important. But which direction is it going to break? And we'll cover that when we come to a little quiz about buying and selling. They think patterns mean something. So which ones are they? We've talked about pennants. We've talked about all of these other things. We've talked about other patterns like candlestick patterns. You know, a reversal candle, a doji, a pin, 3 crows flying off of a low-hanging fruit, or some of these crazy ideas. They're all patterns. They're all something that you're all probably have all read about. You've probably all bought books about. Some of you may even have done courses on. And some of them are useful and some of them are not, but which ones are useful and which ones aren't? Is a pin bar useful? Does it tell us anything? We'll obviously talk about that. Sometimes it does and sometimes it doesn't. A lot of retail traders think that the joy of retail trading, or the joy of trading in its entirety, is because you can choose your own hours. You can't choose your own hours. Well, that's not strictly true. You can choose your own hours, but there's huge consequences to your trading style and your performance, and a lot of retail traders don't want to hear that. Oh, well, I came into trading because I can take control of when I play. Absolutely, you can absolutely do that. But you've got to remember that institutions can't do that, and therefore if you've got any intention of trading like the institutions, then you can't pick and choose your hours. Obviously, you can turn up at the screens if you want to make money, and you can decide not to take a day in if you decide not to. That's okay, that's all fair enough. You can't come in at 10 o'clock in a London session and think you're going to do anything of any interest. I shout at the guys every morning that turn up at 10 o'clock, not the guys that work for us, but the guys in the room. You know, they come in and say hello, and you go, what are you turning up at this time for? There's nothing for you to do at the moment. There's nothing here. Either you start at 7 or 6 in the morning, London, or you start for the US Open and you get ready to actually take advantage of when the actual institutions are going to make some decisions, and you're in place to make those decisions. So it's difficult. You can choose your own hours. Of course you can. There's nothing stopping you coming in at 10 o'clock. But just realize that you're not going to be starting to get into a big macro accumulation at 10 o'clock in the morning. It sometimes happens, but more often than not, it's probably an exit. Because when we come in at 6 o'clock, start trading at the Frankfurt Open at 7, enjoy some action at 8 o'clock for the London Open, we're normally exiting at 10 o'clock, 11 o'clock. That's normally our day finished. And a lot of people think that it's brilliant in Europe and London to start late, get out of bed late, start late, come in at 10 o'clock, and then all you're doing is picking up the dregs that we've left behind. That's all you've done. You think a 10-page PDF will prepare them for success in the retail space? It won't. It won't. It won't even scratch the surface of trading a 10-page PDF. So buying the latest course and it's on a one-page cheat sheet, it's not going to be very good. It's going to help you. You know, I've always said that to guys, make sure you put some post-its around and, scribble your notes down. Make sure you're always on top of what's happening in the markets to remind yourself not to make mistakes. You think that by doing any educational course that they will become successful, highly profitable traders. Well, unfortunately, some will, and really unfortunately, some won't. And why is that the case? Well, because obviously it's the same as any other. It's the same as any other educational course. You might take a course as a surgeon. You might do a degree as some sort of doctor's degree, surgeon degree. It doesn't mean you're going to be a great brain surgeon. You might not even get a job as a surgeon. I know a colleague who's done a law degree and he sells telephones. He sells telephones. He couldn't get a job as a lawyer. So when you look at it, it's the same course as somebody that's now a senior partner of a law firm, and he's selling telephones. So when you stop a second and think about it, just by doing a course doesn't guarantee that you'll become that person that you want to become. It's all about application, isn't it? It's all about application and your ability to take the material that you're taught and make something of it. It's not my job to make something of it. It's your job. I'm the teacher. You've got to become you've got to become the material. You've got to take ownership, and that's what comes back to that original headline that we started with, that original quote we started with about ownership, extreme ownership. You don't pass off the failures to somebody else. You own these failures. You say, that was my mistake. I made a boo-boo on that one. I'll move on. So here's the next problem for retail traders. Here's the next problem. What is trading? What is it? Which offer are you going to take up? And this is another problem. And in fact, when I was talking to or hearing the conversation from the guys that were good enough to hold the last webinar where we had to meet the students, where they were chatting through, and what they were talking about was basically a conversation, an argument, in fact, about what trading actually is. Is it based on technicals? Or is it based on fundamentals? Well, guess what? It's based on both, technicals and fundamentals. If you want to be an accurate retail trader, you've got to know both. You can't be a technical trader without understanding fundamentals, and you can't be a fundamental trader without understanding technicals. Is it about volume analysis? There's a lot of great courses about volume out there, very good courses about volume. Volume equals activity, and we all know that activity is what commercial business likes. You want to see some commercial activity at certain prices. But is it bullish or bearish activity? Guess what? I'll give you a clue. Sometimes we buy at bottom edges, and sometimes we buy at top edges. We put very, very large volume in at top edges. Sometimes these volumes at top edges in the stock market are done via a little process called the dark pools. Sometimes they're done in block orders in terms of the futures markets. Sometimes they're done off exchange in terms of spot forex, because obviously it's not on a listed exchange like the CME. Perhaps it's on the 6E contract or the 6P contract. So is it volume analysis? Is it candlesticks? Is it the doji or the spinner or the pin bar? Is it the upthrust bar that we're interested in? Is it the piercing line that we're interested in? Is it the engulfing candle? Which one is it? Well, guess what? You can use candlesticks. It's not a waste of time doing that course, because they can be useful. But when are they going to be useful? When are you actually going to make use of them? That's the big question. Volume spread analysis. So mixing a bit of candlesticks in with volume itself, what does that tell us? Sometimes a lot, sometimes nothing. Is it market profile? You've all read Stoudemire. You've probably all read Stoudemire. You've probably all read Dalton. You've probably picked up some interesting pieces of information, but do you use it? Do you know when to use it? Do you know how to use it? Do you really have a grasp? Yes, a great graphic. But what the hell is it telling us? That huge big distribution at the top, is that a buy or a sell? Some books you read, it'll suggest that volume at the top is a buying opportunity. It's called a P shape, if anybody's done any profile. And everybody thinks it's a buying opportunity. And then other people will say, but that's volume at the top edge. The volume guys will come back and say, volume at the top edge, that's not a buy, that's a sell. So the profile guys are saying it's a buy. The volume analysis guys are saying it's a sell. Which one's right? Take your pick. Toss a coin. You've probably got a 50-50 chance. Is it volume delta? A lot of people have done volume delta courses. They've bought courses. They've bought books. They've searched YouTube. Always a favorite. Search YouTube for volume delta courses. Volume delta information. Well, yeah, sometimes it is. It's not that important, but yeah. It has an element of importance that we can pay attention to, especially when we start drilling down into the very, very small short-term charts. Is it option selling or buying straddles or legging into condors that is the way to go in terms of trading? Should that be the course you buy? Should you be buying about how to cover calls and all of that type of stuff? Well, yeah, perhaps, if that suits your style of trading. Or is it just straightforward stock picks? Do you want to just get into buying stocks? Buying and holding, in other words, just basically just doing what pension funds do or doing what mutual funds do. Or is it about learning about dark pool activity? Good luck with that, because you're not going to learn very much. You'll learn how it works, but you're still not going to learn very much about it. That's why it's called a dark pool. They don't want you to know about until the trade's finished. Is it about market internals? There's plenty of good courses out there that tell you all about market internals, about the tick and about the trend and all of these lovely things, the advanced decline lines. Brilliant. Yeah, they're all very good, but which one is it? Is it about spread trading? You've all probably heard some spreads and you say, I quite like the idea of that spread. I quite like the idea of the Brent WTI spread, for example. I quite like the idea of maybe a calendar trade. I quite like the idea of the crack spread. I quite like the idea of the crush spread. Well, perhaps it is, or perhaps it's a spread to do with the bond yield curve. Maybe the 2s 5s or the 5s 10s, maybe even the 10s 30s or the, God forbid, the 30s, or the 10s 30s or the 30s ultras. Is it order flow or footprint trading? And finally, is it swing trading or position trading or scalping? The biggest challenge is Guess what, guys? It's all of these things. It's every single one of these things. So if you pick and choose bits of courses, no wonder you're back in this room listening to me babbling on at midnight. Because when you look at all of these choices, you say, well, every single one of them's a choice I've got to make. I've got to decide between, should I do volume analysis next? Should I do profile next? I don't know, perhaps it is that. Buying an iron condor or legging into a short iron condor, or maybe it is to do with order flow. Maybe I should do something with order flow footprint. I love that last email I got about footprint charts from this company. It's about all of these things. And this is probably, I say, because I don't know, but this is probably the only place that you'll learn about all of this stuff. Every single last piece of this is going to be included in this overall course, the big course. And the reason for that is there are elements of everything in this that are absolutely true. And that's why a lot of retail traders are struggling, because they don't know which one of these, out of all of these massive amounts of things that we've got on this list, they don't know which one it is. So I really genuinely can feel your pain. I've had many retail traders asking me, what should I focus on? Should focus on all of these things. It's part of the whole trading scenario. That's why trading isn't easy, because you've got to know all of it. You can't pick and choose bits. Each bit might make you a little bit better, but guess what retail traders as a rule generally do? They'll go and learn something to do with volume analysis, and then they'll pick up a book on market profile, and they'll forget about the volume analysis. You've got to compound that knowledge. You've got to build on each of these elements through the process, through to the point of, I know exactly what the trade is, and I know exactly where the trade is. And we're going to touch on this. So let's talk about some of these trading styles and trading ideas. The first thing that I've heard a lot of people saying is, I want to trade like the commercials. So I've heard that the commercials are the most intelligent, in touch with the market traders that there are. Absolutely. You are absolutely 100% correct. But some of them are farmers. Yeah, they're in touch with the market, but they're not in touch with the market as in the futures. They're not interested specifically in the order flow. They're interested in the price that's out there, and they're interested in volume. So if you want to be order flow, they're interested in the price that's out there, and they're interested in volume. So if you want to be trading like a commercial, and a lot of people say, yeah, I want to trade like the commercial, well, you're going to have very, very, very deep pockets. Because unless you own the underlying asset, you're going to be in trouble. Trading like a commercial, let's look at the CFTC's own definition of trading like a commercial. Class as a commercial if the trader uses future contracts in that particular commodity as defined by CFTC Regulation 1.3. A trading entity generally gets classified as a commercial trader by filling in a statement with the Commission on Form 40. The statement of reporting trader that is commercially engaged in business activities hedged by the use of the futures or options markets. In other words, hedgers. Commercial traders are sometimes extended in terms of the use of the word to commercial hedgers. In other words, trading in the futures and options is not their core activity. And the people that we're talking about, therefore, are people like oil refiners, producers, farmers, cereal sellers, for example, in the ags market. And this is important when we consider things like the basis trade. Do you know what the basis trade is? The basis trade is trading the difference between spot market and futures. And there's a very, very substantial amount of volume goes through in the basis trade. In other words, a lot of trade, for example, in the bond market, a lot of people think the bond market is the futures. And they forget that the bond market futures are based on actual physical bonds that change hands every single day. I could go in and buy $1 million of treasury bonds. I don't have to buy a future. I could buy the bonds and sell the future. That's called a basis trade. And that's what a lot of banks do. Did you even know that that's what a lot of banks do? Perhaps you did. Perhaps you did. Does it help you with your knowledge of trading? Yeah, sometimes. Sometimes you probably or possibly heard of things like the Prem on the S&P. It's a very similar concept. It's an algorithm, but there's a lot of people, well, not a lot of people, there's a couple of people perhaps selling courses on the Prem. Well, you're going to learn all about the Prem and its limitations. It's not a trade that you guys can do. It doesn't really give us a huge amount of directional information, but it does give us an initial almost arbitrage scalp opportunity to get into a trade at a certain price. Very, very short term, of course. So when we look at commercials, here's a chart of a commercial CFTC. It's the Commitment of Traders report, of course. And it has this listing of producers and users, which are commercial traders, and then speculators, which is the blue line at the bottom. And the one thing you'll be able to recognize when you look at the producers and users on this screen is that they go long when the price starts dropping, and they go short when the price starts rising. Well, that seems to make some sort of sense, doesn't it, when you think about it? Seems to make some sort of sense. Because if I take a look at, for example, a farmer who owns a crop of wheat for delivery in 2 months' time, what does that farmer do? Well, they own the crop of wheat. They own the wheat. So what does a farmer do during the process of this price movement in wheat? Well, as the price rises, the farmer starts locking in some of that profit. So they sell some wheat here, and then they sell some wheat here, and then they sell some more wheat here, and perhaps they sell some more wheat here. And now the farmer, through the fact that they know how far the price goes, they know what kind of supply there is of this particular wheat, then obviously they might believe that that's it and it's not going to go any further, and they sell the last batch of wheat at this price. That's them. They're now fully committed into that trade. They can't do anything else. They're now fully committed. And obviously, when you think about it, their position in the markets is now completely 100% short, isn't it? In other words, as the price rises, the commercial gets short and more short and more short and more short as the price increases. And that's what we saw from the earlier slide, isn't it? As the price increases, the commercial gets very, very short the marketplace. Well, that's correct. As the price increases, in this last leg here, this is the price of natural gas, the commercials get very, very, very short. Well, that's true. So if you want to trade like a commercial, all you do is you sell on upticks, sell on upticks, keep selling on upticks. Guess what? If that's all you're doing, you're going to get busted out of your account very, very quickly indeed. Even if you adopt a trading style called a martingale, God forbid. Because a martingale is what the commercials do, but they're hedged against the underlying product. So you can't do the same as commercials. You can't do it. You can pay attention to the commercials. There is information contained in the COT that can help you in the bigger picture trades. An acceleration, for example, in hedging tells you that there's a possible top edge or bottom edge starting to get put in the marketplace. It's not the direction that's important, it's the speed that's important in that case. So what else could it be? Well, a lot of people think about trading and they think about something like this. Indicators, goddamn indicators. They love it. They love these indicators, don't they? They love letting indicators do the hard work. They love the red arrows and the green arrows, and they love generating these little charts that give you, this is a linear regression breakout channel trade. And you can see there that it's terrible. It's absolutely tragic. The percentage profitable trades is 32%. It's you can see the maximum drawdown. It's almost too large to even calculate. It's a horrible trade. And this is supposed to be a mean reverting spread. This is supposed to be a mean reverting spread, and you can see it actually trends. You can see that there are several trending periods during this process. So even a breakout strategy gets annihilated. And that's just an automated EA stuck inside your free fall. No wonder it's free, guys. It's rubbish. So a lot of retail traders, however, let the indicators do the hard work. Well, you're not a trader if that's the case. You're not a trader. It's the same as giving your money to a fund manager and letting them do it. It's not very good, is it? And guess what? Guess what's going to happen if this is how you proceed? Because this is where most retail traders are at with their trading. You're going to spend your entire trading career adjusting settings on these damn indicators. And then you're going to go into Forex Factory forums and you're going to spend the rest of your night or the next day or the next weekend talking about parameters. You're going to be talking about changing the period from a 5 period to a 15 period. And then you're going to say, well, let's filter it with adding this other thing in. And you think, what the hell are you doing? Sound familiar? Because this is where most retail traders are at. They're trying to find this setting on an indicator. In other words, they're trying to be quants, to be honest, rather than traders. A lot of retail traders, a huge number of retail traders, and as I said, you've probably seen them in Forex Factory talking about different indicators, different settings. You'll find them in the market profile section. You'll find them in the moving average section. You'll find them in the linear regression section. You'll find them in all different sections, order flow sections, order book sections, limit order book sections. And they're all talking about settings. They're all talking about parameters. And not one of them, probably not true, probably 99% of them don't actually even know about statistical sampling. They don't have a starting point. This is what a normal statistical learning approach to yield curve forecasting looks like. How many people in your Forex Factory, for example, can even tell us what any of these symbols mean? Never mind what the equation is and why the equation's of any importance. Analyzing settings on an indicator is not about whether you should change it from a 5 period to a 15 period. That's bollocks. It's a waste of time. What the hell are you doing? You honestly think that's what quants do when they're getting paid $1 million a year just to sit in a wee office and talk to each other? Do you think that's what they're doing? Oh, I wonder if we should change that. I wonder if we should change that moving average from a 5 to an 8. That's going to make a big difference, isn't it? Yeah, let's try that. What about an 8 crossover from a 50? Oh, well, let's try that one. See how it goes. Let's see how it goes. Absolute rubbish. Absolute rubbish. So when we move on, trading like a market maker. We've seen an awful lot of people in the retail space that want to trade like the market maker. Why? Why would you ever want to trade like a market maker? Do you want to be on the side of the market maker, or do you want to trade against the market maker? Well, it depends. And the answer to the next question is, well, it depends on what precisely? Exactly, it depends on what. Do you want to trade with them, or do you want to trade against them? Well, if you're obviously looking at the prop traders, you're normally going to be trading against them. And if you want to trade with the market maker, then obviously you're going to be trading on their side. But which one is it? You can't take both sides. Oh, you can if you're the market makers. You'll be buying on the downtick and you'll be selling on the uptick and taking a one-tick spread. The problem with prospective traders is they find it difficult to be precise. And why is that the case? Because they just simply don't know. They've been fed a constant, never-ending barrage of emails and marketing about courses, just like this one. Just like this one. You've all had an email about this course telling you to trade like the banks. And yet you still don't know whether the trade like the banks is even close to what you're going to be doing. With only experience of talking to other students, are you ever going to know whether this is actually how the banks trade, or by talking to other bank traders and saying, is this what you guys do? And the interesting thing is that a lot of people in the room will highlight and spotlight perhaps a little conversation, an interview with a market maker, for example. And they'll highlight an interview with a market maker, and the market maker will then confirm everything that we've been teaching perhaps in the class the week before, which is exactly what happened just actually the other week. We were talking about toxic order flow, and somebody came in and said, well, there's a YouTube video about somebody talking about toxic order flow. And we'd already covered the subject. We'd already made notice of it. And in fact, we've got an indicator that highlights it in terms of a non-lagging indicator, but we'll cover that in a moment. So do you want to trade like the banks? I want to trade like a bank trader. Do you realize that the vast majority of bank traders are just order fillers? They'll take a phone call from a commercial and they'll say, well, you're going to see what you can get for me for a couple of thousand lots or a couple of thousand shares or whatever. And their job is then to try and find a trade. In other words, there'll be a broker for that trade. They'll try and find somebody on the other side of the trade. They'll maybe do a bit of business on it. And that's it. They don't know how to trade. They've got no idea how to trade. They don't know whether the market's going up or down. In fact, they don't really care. All they want to do is get volume. They're all volume business traders. This is why we had things like the This is why we had things like the LIBOR crisis, because we had traders that were able to manipulate brokers. Massive difference between the two. The trader's the guy that lives in the big mansion at the end of the road, away up in the hill, and the broker's the guy that lives in the mid-terrace in the middle of the street. Massive difference. Massive difference between the two. A market maker tries to be market neutral at all times. Does that sound like the type of trader that you want to be? Do you want to always be market neutral? In other words, you don't want to be necessarily buying it to get a long position or selling it to get a short position. You just want to get neutral at all stages. Sometimes they are, and sometimes they're not. Sometimes they end up with a bias, not on purpose, but because of the way the order flow has hit the book. They trade for the bid-offer spread on volume. That's what they want to do. A market maker's best day is when price doesn't go anywhere. The chart on the left-hand side is from our own software, highlighting a 5-minute period where we've identified the market maker finding what we would call toxic order flow. On the far left-hand side, you'll see that there's a top edge forming here. It's the actual NASDAQ itself. And one of the things you'll be able to recognize is that there's a green line dropping hard and fast at that stage down the left-hand side of the screen. You'll see that the green line drops several minutes before the price drops. It doesn't repaint, but it drops before the price drops, and you can see that there's a couple of little billiard balls at the top edge. And obviously what happens next is that the price then rolls over and falls into this downtick. Well, what's happened in that situation there is this green line, it's not exactly right, but this green line is very, very close to the research findings that were made on several documents, and I'll go back over some of those documents about toxic order flow. This green line detected some toxic order flow, selling order flow at the top edge of this market, and showed very, very aggressively that there was a toxic top edge forming here. In other words, the market maker has detected a toxic top edge, and that provides us with a selling opportunity to make a quick scalp profit on that. Pretty damn tootin' good. A leading indicator that doesn't repaint, guys. Holy moly! So what else? What else? So the market maker we've talked about tries to be neutral. So here's the difference. This course comes with no guarantees of success. I'm not saying you're going to find that trade on every single screen, every single day of the week. You'll see it in, nearly always every single day of the week. Because obviously the whole point about trading is being choosy about what trades to take and what trades not to take. But this is another problem for retail traders. How do you tell? How do you know which is a good trade and which is a bad trade? Because of a candlestick formation? Is that good enough to get a trade on because of you've got a up thrust bar? I'm sorry, guys, it's not. If it was, you wouldn't be here, would you? This course comes with no guarantee of success, no wild claims of riches. Some of you will be good and some of you will be bad. Some will be rank rotten, and some of you actually might be very good. Some will apply the information that we're going to provide, and some will develop. Others will go back to looking for indicators that work. Good luck. I hope you do find them. But there's no guarantees. There's no guarantees at all, guys. It's all about your application. But the one thing you can guarantee is I will work my butt off to get you to where you need to get to. And the guys in the room will confirm that I do not shirk from that responsibility. I want to make sure you guys get to the very top. And then sometimes there's some ugly truths. Kim said it at the start. Sometimes there's going to be some ugly truths. I shout, I bawl, I holler at people in the room. Sometimes I'm being serious. Sometimes I'm not. I'm having a bit of a laugh and a carry on. But it's not all nice. You can't be nice in the markets, guys. You've got to step up and you've got to be willing to get the sleeves rolled up and get busy. But I will be with you every step of the way. If you've got a problem, we're in the room, we talk, you can ask questions, you can always get answers, and we discuss and we go back over stuff over and over again until you get it. Until you get it. And sometimes I just get pissed off and I don't bother answering any of your questions. So that's just how we feel sometimes. So we go back to the question, do you still want to trade like algorithms or the commercials or the HFTs or the market makers? I've just reprinted a couple of little articles here because I wanted to show you some of the things that do happen. You've all heard of the flash crash. Well, in September 20th, 2010, the SEC and the CFTC released a joint report into the investigation of the flash crash. And they identified that there was a They identified that around about 2:32 p.m. that day, a trader from this firm of Waddell and Reed started a sell program to unload 75,000 E-mini S&P contracts worth about 4.1 billion US dollars. An enormous sale for that instrument. So when you're looking at this, a 75,000 contract short, 75,000. And a lot of you guys are looking at an upthrust bar on a 1-minute chart and thinking that that's a commercial trade. Cannot believe it. Cannot believe it. There's a trade there, guys, that they're talking about 75,000 lots traded. Before we carry on with this, let me just look at this. Banks and institutions. Banks and institutions are not price sensitive. Believe it or not, we could give a Castlemaine about what price we get. We want to make sure we get volume, big volume. We want to get the best price, but we're not sensitive to price. We're sensitive to volume. Do you agree with that? Well, you should agree with that, because is this candle here institutional selling? And when I keep saying it depends, that sounds like a huge cop-out, doesn't it? It depends. Well, it depends on what? Well, is it institutional selling? Well, if this candle was, of course, a daily candle, then there might be quite a substantial amount of volume in this pin. However, if this is a 1-minute chart, and if I was to draw this in the market as the oil markets, let's assume that the very top tick price has a 1 lot traded, the price below that has a 5 lot traded, and the price below that has perhaps a 20 lot traded. So that's obviously the volume. Is this an institutional sell candle? No. How can it be an institutional sell candle with 20 lots? Now remember, that's 20 lots traded between perhaps 50 large institutions that are all trading oil that day. How are we splitting that up? In other words, if I'm trying to do a normal size trade of maybe 1,000 lots on the oil, it's going to take 50 of these 1-minute candles in that area to get that 1,000 lot trade on. And that's assuming, of course, that I get 100% of the trades, which obviously I'm not. I'm going to get a small percentage of that. So if, say, I get 10% of all of the book volume, 10%, that means it's going to take 500 of those 1-minute candles for me to fill my 1,000 lot order. 500 1-minute candles. That's a lot of time. It's not a single upthrust bar on a 1-minute chart, nor is it even a single upthrust bar on a 5-minute chart, is it? Of course it's not. So you've got to start deciding, when you look at a chart, you've got to start looking at that and saying, I've got to build a narrative of whether the commercials are even interested in this, because it's important about whether I should be buying this or selling this at certain prices. It's very, very important to me to know whether the commercials are dealing. Just taking a single price action chart that gives you a single top edge candle like that doesn't give you the information that you need. How is this guy going to get 75,000 lots if that's the S&P top edge? How is he going to get 75,000 short? How's Goldman's going to make a profit to pay their extortionate wages if there's a 20 lot traded at the very top edge pin bar? They're not, are they? They're not. So when we go back to this little chart, when we go back to this little conversation here, 75,000 S&P contracts worth about $4.1 billion, an enormous sale. The rate of selling was pegged to 9% of trading volume in the previous minute. Do you see how some of these algorithms are structured? 9% of the volume of the previous minute. There's a time slice on this and there's a volume slice on it. Every minute, 9% of the previous volume is then traded. Well, think about this. Think about this. What happened was HFT firms, high frequency trading firms, took the other side of this sell program. And a lot of people say, well, I want to trade like the HFTs. You do realize, of course, that HFTs trade with HFTs all the time. There's longer term algorithms that are trading. There's short term algorithms that are trading. Sometimes one of them's trading on the buy side. Sometimes one of them's trading on the sell side. They're trading with each other. So which one do you want to trade with, the buy or the sell? Who knows? Well, we do. We know which one to take, and we'll show you why. So what was happening in this example was that there was an HFT taking the buy side of that trade, that 75,000 lot sell, bearing in mind that there's perhaps 1,000 lots going on the order book. So 1,000 lots hits the order book, 10% of the previous volume, and the HFT buys it. Now, the HFT normally buys it to try and make a quick one-tick profit or thereabouts. So they buy this 1,000 lots and the price doesn't uptick by 1 tick. Why does it not uptick? Because coming into the next minute, for example, the big seller comes back in. It doesn't matter what price. The big seller comes back in and sells another 10%. So they sell another 1,000. And the HFT takes that other 1,000 trade and it's at the same price. And they take that 1,000 lot sell and it still doesn't uptick. And they do this and all of a sudden they've got several thousand lots long. This is the HFT. They've got several thousand lots long and they suddenly realize lots long. This is the HFT. They've got several thousand lots long and they suddenly realize, what the hell, I cannot make the price go up. It doesn't matter how many I buy. The price won't go up. They're in the wrong trade, aren't they? They've just found some huge order on the other side of that trade. And what happens to the HFTs? Well, you can see what the CFT said happened to the HFTs. High-frequency trading firms initially picked up the contracts with the intention of quickly turning them around. But the subsequent glut of contracts on the sell side caused the price to drop further. So obviously the price was crossing the spread. There was that much selling coming in. The HFTs were initially buying. The high-frequency trading algorithms panicked. Panicked. An algorithm panics. In other words, it just starts to dump everything, sparking the 14 seconds of fevered trading in which 27,000 trades were made. So there's a problem, isn't there? So the HFTs got beaten by the sell programs. And a lot of people think, I want to trade like the HFTs. I need to know where the HFTs are trading. You don't, because it's pointless knowing. It's not going to help you. It's not going to help you. It can start to help you with other things as other trades develop, because obviously we can start identifying where those types of algorithms are kicking off. We showed that earlier picture of the HFTs coming in on the previous slide. We saw that toxic order flow at the top edge, allowing you to get that short trade off the top edge of the chart. So when we look at this, we can obviously then look at some of the reasons for and some of the ways we can start establishing how we can identify that toxic order flow. And you don't need to know any of this stuff, guys. That's for the quants to know. But it's not an indicator setting of a change of period on your charts, is it? It's not the kind of equation you say, you know what, I'm just going to change a setting and I'm going to change it from a 5 period to 15. It's not going to work, is it? The volume traded against the ask versus the volume traded against the bid. Very, very simple. Start looking at those types of elements, in other words, order flow, and you can start to detect certain sequences. But guess what? It happens so quickly that you've got to be rapid like this stuff. You can't take 2 or 3 seconds to think about it. You've got to take a fraction of a second to see this information and act on it. Well, we've got indicators in our own package that allow you to do that type of thing. It allows you to see these types of elements coming in. In other words, proper professional grade information on a retail platform. So again, go back to your question. Do you still want to trade like algos or the commercials or HFTs or market makers or buy and sell programs? Which one do you want to trade like? You still don't have a clue, do you? You still don't know which one is the right one to choose. And I don't blame you for not knowing, because we haven't covered any of that stuff yet. Well, obviously, the other thing you can find when you're looking through all the trading literature is this stuff here. Patterns, wedges, pennants, double tops, head and shoulders, trend line breaks. They're all very subjective, because obviously which line is the correct line, that's always going to be a problem for a lot of people when they start drawing these trend lines. It looks very easy in hindsight when you see this brilliant breakdown of a line that you've drawn randomly across a chart, or a line that you've joined a couple of dots. But you can see that by looking at these charts, the one on the left and the 2 charts on the left look as if they're fantastic. Breakout buy, look at it go. Breakout sell, look at it go. Why did it sell? Why did it buy? Because it broke a trend line. Well, if it was because it broke a trend line, why was this not a buy just here on the right-hand chart? Same chart, different trend line. Why was that not a buy right there, which resulted in a very substantial loss? Why was this break of this trend line not a buy here, which resulted in a substantial loss? So in other words, there were 2 breakouts of 2 different trend lines that would have resulted in losing buy trades. So why are they not highlighted? Because it doesn't serve a purpose. It doesn't serve the purpose of trying to sell perhaps a book or a strategy In other words, it looks as if it's ugly and it is ugly. It's not applicable. You can't use this information to make money with. You think you can, but ultimately you can't. It's very subjective. Which line is correct, which is wrong. It's very much like Fibonacci and Elliott. If you ask just one single question, it becomes possible to start breaking out from all of this noise. What is that question? Well, it's not, are we getting a wave C extension of an ABC correction? Or are we about to see a wave 5 forming? Or are we at the 1.6 projection of a Fibonacci retracement? It's none of that stuff, guys. It really isn't. Seriously, it's not. So the question that you've got to ask is this, and this is probably the most important question you can ask in trading. Kim's already covered it. Why? Why is price breaking north out of that channel? It's not because of a rising or falling wedge, guys. It really isn't. It's not because it's broken a moving average line either. It's not because it's broken a neckline of a pattern either. Nor is it because we've completed or we haven't completed a wave C of an ABC correction. It's none of those things. It could be breaking up to provide liquidity for a short trade. In other words, if I want to get short, I might buy the market to try and force some liquidity at higher prices so that I can get short at a higher price print and get liquidity, volume at a higher price print. It's called capping. It might be a hedge trade that's coming into the market. Perhaps it's a buyer at higher prices because it's tripped some hedge opportunities. Perhaps somebody that's has taken a strike price in an option. And because we've broken through a key price level, which the strike price was sold on, they have to buy at higher prices to hedge out of that position because they don't want to have unlimited loss. So they have to buy at higher prices. Well, we can use that information to sell against. Do you know which price it is? Do you know when that's going to happen? Well, the answer is do the course, and the answer will be yes, you will know exactly where that is and exactly why it's happening. Is it because the market maker started to detect toxic order flow on that side of the book and wants to test higher prices or lower prices? In other words, it may be bullish, but it also might be bearish. So a price breaking up could be bullish or bearish. So far, what have we learned? We've learned that all of these technical indicators sometimes can be useful, and a lot of the times may not be useful, 50-50. In other words, when you know how to use them, they could actually apply some information that you could use. But a lot of the times, if you don't know how to apply them, it's a 50-50 toss of a coin. How many times have you seen failed breakouts? How many times have you seen breakouts that haven't failed? 50-50 toss of a coin, isn't it? So which ones are good and which ones are bad? If it goes through by 5 ticks, is it good? What about 6 ticks? What about 10 ticks? If it goes through by 20 ticks, is it good? Is it a solid breakout? Perhaps it is, perhaps it isn't. See where the problem is, guys? It all comes down to a subjective analysis. It's broken out enough to be a good breakout. Bollocks. Doesn't matter. Doesn't matter. Doesn't matter one jot how far it's broken out if you don't have a good idea about why it's broken out. When we take a look at another chart, take a look at this chart here. Now, there's a top edge breakout here. The market goes very fast to the upside. It's something we actually teach in the room, is about the fast money, slow money principles of the market. This looks like it could be a good buy side breakout. Why is there a sell arrow at it? It looks like you can see in the left hand side of this chart, you can see a top edge and there's a line. Why is there a sell arrow here? At the bottom edge of this bracket, you can see there's another pink line and there's another breakout here. Why is there a sell arrow at the bottom edge? It looks as if it's a failed breakout to the downside. Why is that a sell trade? You might be saying, well, because it's a falling wedge. Okay, well, if it was because it was a falling wedge, is this not a falling wedge here on the left-hand side, in which case that breakout which failed has cost you money, hasn't it? Well, the answer is no, it's not because it's a falling wedge. It's got nothing to do with the shape. It's got nothing to do with the shape at the end of the day about how this market's developing. Is it because we've got some numbers on the charts? Well, that's part of it. That's the fundamentals of this particular trade. There is some fundamentals in this trade that give us a good read on this. But if you take a look at the first sell arrow, it's a break of the top side. Why is it not a buy? Price breaks hard and fast to the top edge. Looks like a buy. So why have a sell arrow at that break? It's not because I can see what happens next. Why is there a sell arrow at the low price and the market breaks south? Why? Ask yourself if. What are you using in your trading right now that would have told you about that top edge sell and that bottom edge buy? Think about it. What are you using right now? Not what am I using, but what are you using? Stochastics? Well, what would the stochastic be telling you? They would have told you to sell that top edge, and they probably told you to buy this bottom edge. If you were using an MACD, they were probably seeing a bottom edge divergence in here because of the slow grind to the downside. The MACD would be rising. It'd be negative, but it'd be rising. MACD divergence, so that would be a buy trade, and it sells. It's none of those things, is it? When we look at the value in this market, you'll see in the next slide, you'll see how we value this market. Then you can see quite clearly why that's now a sell trade. The value collapses hours before that top edge is even put in. The value that hedgers use to price this market collapses hours before that top edge is even put in, guys. So there's no question about what that top edge is anymore. It doesn't matter whether we get an up thrust bar, a little spinner bar, a little doji, a falling hammer, a rising shooting star, or 3 candles to the north or 3 wise men to the south. It doesn't matter what it is. It's a sell trade. It doesn't matter if we get big volume or small volume or in between volume. It's still a sell trade. You see the point? It doesn't matter if it breaks the top edge or doesn't break the top edge. It's still a sell trade. And when we hit the bottom edge, it's not gone bullish. It's still very, very bearish. It's still a sell trade. It doesn't matter whether we get a pullback or whether we don't get a pullback, whether we get a 50 pullback or whether we get a 66 or 68% retracement or a 33% retracement. It's still a sell trade. It makes no difference. It doesn't matter if we get another little spinner here and then it sells, still a sell trade. And obviously it just trades down to a target price at the bottom edge. You can see it ends up way down here. This trade ends up making $1,000 per contract. $1,000 per contract, guys, over the course of about 2 days. It's a swing trade, of course. It's a 30-minute chart at the end of the day. It's not a 1-minute chart. But $1,000 on that spread trade just by realizing and understanding the concept of value. And that's just from the top edge to the bottom edge. It doesn't include the takeouts and add-ins and takeouts and add-ins. Do you not think you need to know what the line is? Do you not think it's very, very useful to know that the banks are going to be selling that top edge? Do you not think that's the most important thing you could ever know about this chart? Well, we'll teach you what these things are on every single market that you could ever imagine. We'll teach you what these lines are on soybeans, on wheat, on oil, on natural gas, on the Brent oil spreads, on the crack spreads, on the euro-dollar spot forex markets or futures, on the pound, on the Aussie dollar, on the Japanese yen, on the US dollar, on gold, on the S&P, on the NASDAQ, or on the DAX, or on the FTSE. We'll teach you every single one of these markets, or whatever market you want to learn. We'll teach you how to start the process. We'll teach you how to start understanding how the banks price the markets properly and efficiently, so that you're not going to be fooled into taking trades because of candlestick formations. You're going to take trades because that's what the banks are going to be doing, regardless of what the damn candlestick looks like. Pretty simple stuff, really. It is used by every single bank and commercial trader and forms the basis of nearly every single HFT and order flow algorithm in existence. And I should know because I've designed a lot of them. And we use valuations in many different forms and in many different ways to develop out trading algorithms, HFTs and algorithms, HFTs as opposed to algorithms for time slice type orders or volume slice type orders. So here's a question about market makers, a very quick question about market makers. Quite an interesting question a lot of the times. And this is the question. Is it better to get a great fill or a terrible fill? It's an interesting question when we're talking about order flow, because the first half of our course when we get started in the new classroom is just going to be about specifically about order flow. But I want you to think about it. Is it better to get a great fill or a terrible fill? Interestingly enough, the answer is usually it's better to get a terrible fill. And the reason for that is the liquidity providers or the market makers are not normally known for their generosity. So if you're a buyer at a bottom edge, for example, and you get a brilliant, in fact, you get a tick better than you even thought you were going to get, you're probably just about to get busted on the bottom edge. You're probably going to go lower. You will end up getting squeezed off the trade. This is why martingale types trading systems will eventually blow your account. Institutions do use martingales of adding volume at lower prices, but a lot of the times those trades are hedged. There's a hedge opportunity, and because of the hedge opportunity, buying at lower prices is not a problem for institutions. So this is the big issue, isn't it? If you're getting a great price, it's probably a bad trade. Take a look at this chart here. Now, the one thing you'll be able to recognize from this chart is it has several of the same instruments that you've got, several of the same indicators that we had on the previous chart. You can see that green line again. And the green line is the toxic order flow line. The toxic order flow line is telling us that there's toxic buying order flow at the bottom edge here that the market maker's worried about. That's why the green line's going up. So we want to be buying this market, but guess what? See if we buy here, this first white arrow. Goes up a little bit, squeezes, you get stopped out. If you bought here, goes up a little bit, squeezes, you get stopped out. If you bought here, goes up a little bit, squeezes, you get stopped out. So you've maybe had 3 or 4 trades at the bottom edge here that you've got stopped out by 1 or 2 ticks on each trade. And then you buy here at the high price. You buy at this price. And you get a terrible fill. And you think, oh, bollocks, look at the fill I got. What a terrible fill. I bought at the market and I've ended up getting at the top edge of the market. I am an idiot. And obviously the first thing that happens is the price trades against you straight away. And you just say, you know what, I'm just coming off that damn trade. I've just got busted. This is horrible. This is horrible. I'll try buy the bottom edge again. And guess what? You take the trade out at the bottom edge here on this red candle beside the white candle, the white arrow. And what happens next? The price then explodes in your favor. And you think, why the hell did I take that trade out for a loss? I would now be sitting on profits because it's all a game. It's just been gamed. You've just been gamed out of this situation. All the subsequent buyers at higher prices all get terrible fills and they all made money. And the reason why they all made money is because they're going in the direction of the order flow and they're going in the direction of the trade. Now, does that mean that we can't bottom edge fade? It doesn't mean that at all, but you've got to be aware of what you're doing at bottom edges. You've got to be active. You've got to start working prices. You can't just buy and hope that it goes up. You should be buying it, taking a quick profit, stops at break even, taking a profit, taking it out at scratch, buying again at a bottom edge. You're trying to buy like a commercial at the end of the day, and the commercials, you know that if you're buying bottom edges, the price will keep going down, won't it? Why? Because there's a lot of buyers at bottom edges, and they're all weak-handed traders, so they're going to get pushed over. They're going to get pushed over. I want to talk about patterns for a second because I want to just give you a little break to the slides for a second, and I want to ask you the question, buy or sell? It's today's quiz of the day. Are you going to buy these charts or are you going to sell these charts? Are you going to buy the left chart or are you going to sell the left chart? Are you going to buy the right chart or are you going to sell the right chart? What is it you use? Just imagine for a second, guys. You've just switched on your screens, or you've just came into a trading desk and you've said, okay, let's fire up the charts. Let's see what they look like. This could be a daily chart. It could be a 5-minute chart. It could be a tick chart. It could be whatever chart you like. Doesn't make any difference. What is it you're going to do to get a buy or a sell trade on that chart? Have a look at both patterns. They both look roughly the same, don't they? They both came down from a high print. They've started to balance out at a bottom edge. Which direction are they going to go next? Are they going to both go up? Are they both going to go down? Is one going to go up and one going to down? Which one is it? You might be saying, well, we could obviously work a couple of ideas here. What about a trend line break, Ray? I'd be interested maybe in a trend line break. So where are you going to draw that trend line from? Where are you going to draw the trend line from? Are you going to take it from the top edge? Are you going to join that dot there? Are you going to join this dot here? In which case there was a little break there, but it didn't close above. Is that your rule? You've got to have a close above a trend line break. In which case it's not a trade. So the trade would have been this candle here, wouldn't it? This green candle at the very bottom edge of that chart. That's the trend line break. That's where it closed. Well, sorry, but that trade just lost you money. Yeah, but Ray, I would have put the line to that point there. That's a better point. Okay, so you're starting to make it up, aren't you? You're starting to make shit up because you're starting to force fit the best trend line, bearing in mind you've probably missed the other trend lines. So is it that trend line? Well, that doesn't really work out either, does it? Because by the time you get the close, you're near at the top edge of that market. It actually drops back down again. So is it this trend line break? Well, that doesn't work either. Is it this one? That doesn't work either because it still goes above and closes. Is it this one? Well, that doesn't work either because it breaks to the upside, sells back off, and then breaks to the upside again. Well, is it this one? Well, that didn't work either. Is it this one? Well, which one is it, guys? Which one is it? Well, it's none of those, Ray, because guess what it is? It's none of those. It's a bottom head and shoulders. Oh, is it? Oh, thanks very much for informing me of that. Well, there's the neckline. There's the head. There's the shoulder. I can see quite clearly, Ray, that this is a bottom head and shoulders pattern. See the pattern? There's the bottom edge. There's the head. There's shoulder to the left-hand side, shoulder to the right. Here I am stuck in the middle of, and this market's going to break hard off the bottom edge of this neckline break here. So I'm going to be putting a buy stop order just in here. Brilliant. Great trade. Bollocks. Well, what about this pattern here? Is this a buy or a sell? Well, we're getting a lower low print here. So we're getting lower low, lower high, lower low. So it's breaking south. So yeah, it could be a sell. Or is this a falling wedge that's bullish? According to the previous little slide, we could take a break of that. That looks like a bullish break, potentially. Well, which one is it, guys? I want you to be absolutely 100% honest. When you look at that chart, do you have a very, very clear idea of exactly what these trades are? Now, I'm going to help you in this. I'm going to help you. I'm going to help you massively. And you might be saying, yes, I love a bit of help. Okay, so we're going to help you massively, guys. We're going to give you the stochastic of both of these charts. Aren't we generous? We're going to give you the stochastic. And now what you can see is you can now see the overboughts and the oversolds. You can see whether we're getting divergence off the bottom edge or a lack of divergence off the bottom edge. What does that matter? Does it matter? Well, does it? So which one is it? Which is this? Is this, well, I can see we've got divergence on the left-hand chart to the upside. So this looks bullish. I can see that we've got a failed bottom edge here. So that looks really bearish. Yeah, but we've also got that divergence at the top edges here, or this divergence here. What is it? Which one's bullish and which one's bearish, guys? Which one's bullish? Are they both bullish? Which one's bullish and which one's bearish, guys? Which one's bullish? Are they both bullish? Which one's bearish, or are they both bearish? By using the stochastic and using your price action and using your candlestick analysis and using your trend line analysis, is it a buy or is it a sell? Let's take a look at a couple of other charts to see if we can figure this question out even on another chart without using a stochastic. Here's two downtrends. Here's two downtrends. Are they bullish or are they bearish? Is one a buy or is one a sell? Which one's a buy? Which one's a sell? Are they both buys? Are they both sells? If they're both buys, where are you going to get into the trade? If they're both sells, where are you going to get into the trade? You've got to be specific in this process of uncovering whether you're bullish or bearish, guys. You can't be variable. You can't say, well, you know what, I know it's broken a trend line on this occasion, but it wasn't a great break. How do you define a great break of a trend line? Well, it's got to be 10 ticks above it. Who says it's got to be 10 ticks above it? Some crappy back-tested idea that you had in the background? It's just bollocks, isn't it? It doesn't make any sense. When you stop a second and seriously analyze the trade, it doesn't make any sense. It's just made up stuff. It's just playing at being a trader. So which one's bullish and which one's bearish? Are they both bullish or are they both bearish? Think about what you're looking at. Think about how you might be able to force fit a couple of lines on this. They've both got trend lines to the downside, for example. Well, I could draw a trend line off of that point and that point, but what was wrong with that point to that point? Here and here, which means we're already long in this market here. Is this failed trade here a signal that this price is definitely going to break? Are you going to use this as a double bottom So in other words, are you going to buy the break of that double bottom there? Is that where your trade is? If that's the case, on the basis of this bottom edge here, is that also a buy of that break line right there? Or is it a trend line break that you're using off of this line? Or is it a trend line break you're using off of this line? What precisely is it you're going to get into these trades with? What are you going to do to get into these trades? If you're honest, you'll probably tell me that you don't really know. You don't really know because you haven't got your own indicators on it. You haven't got your own stuff. Well, what is that going to tell you? Yeah, but I don't use the stochastic. I use the RSI. You do, of course, realize they're almost identical indicators. They're based on the same basic arithmetic. So it doesn't matter whether you use an RSI, a CCI, or a stochastic. It's based on the same arithmetic, basically. It's just rehashed into a new indicator. It's still based on previous price. No trading is based on previous price action, guys. None. So all those indicators that are traded based on previous price are irrelevant to what's going to happen next. Irrelevant to what's happening next. Unfortunately, a lot of people don't like hearing that because they've invested a lot of time and money on these types of things. But if you actually accept that that is a mistake, if you take ownership of that mistake and say, you know what, it is a mistake. I did invest a lot of time because I didn't know any better. Then that's an honest mistake to make by a retail trader. You didn't know any better because the glossies and the snake oil salesmen have all led you down a path that have led you to nowhere. Because you're still here, you're still coming into a room like this, and you're still looking for the answers. Well, let's take a look at some of these questions here. Let's take a look at some of these questions. If we go back to this and I say, well, what are we going to do on either of these charts? And I change that. And I change that. And we look at this chart here. So this chart is the same chart as the chart below. You'll get the answer to the question, is this a buy or a sell? You'll see that it was actually a sell trade. You'll see it was actually a sell trade. You can see that the price broke the lows and then sold off. The chart on the right, which was this one here, where we didn't have the divergence on the stochastic, that obviously might have suggested a bottom edge, which looks really, really, really bullish, or maybe it doesn't look bullish. I don't know. Perhaps it depends upon how you define what your stochastic's supposed to look like. It doesn't actually make any difference, but perhaps you've got some sort of idea about what the stochastic should look like. Well, guess what? Good luck to you, because it's not going to work. So the stochastic's not telling you whether you should be buying this or selling it, is it? So what does this price do? This second chart, the price rallies off the bottom edges significantly. Rallies off the bottom edges significantly. Look at that break to the upside. It's beautiful, isn't it? Make a lot of money. Yeah, but I'd have bought that bottom edge stochastic. Bollocks, guys, grow up. I'd have bought that oversold stochastic. I'd have seen that head and shoulders. It's just garbage, guys. It's not real. Give it up. Free yourself from all of that shit and actually decide that you want to learn about these markets. Let's take a look at the other two charts. Let's take a look at the other two charts. If you remember these two charts, we didn't know whether they were bullish or bearish. You don't know whether it's going to break higher. They've both got necklines that could break. They could both turn into double bottoms or whatever. This one's obviously at a failed bottom edge here, so it looks as if this could break north. Everybody's got a technical idea. It's a definite bottom edge. It's a definite double bottom. Doesn't mean anything really. But let's take a look at what happens to these two charts. So take a look at the left-hand chart. What was your first feeling about the left-hand chart and the first feeling about the right-hand chart? Are they both going up? Are they both going down? Is one going up? Is one going down? And why? And that's the important question. Why? What's your rule base for this trade? Because whatever your rule base is, you could probably find that you force-fitted it into several other trades that have all lost money earlier. Let's take a look at what happened. This is the same trade here. This trade here broke south. Very nicely, in fact, it broke south. This was the one that failed at the bottom edge the last time. It tried to go back up to the top edge and failed again here and then broke hard and fast to the sell side. This trade that was making new lower lows broke north very hard and very fast to the upside. And you might be saying, okay, well, smart arse, that's all very good. But, how could I have traded? How could I have known? what all of this, if it's not the stochastic and it's not an RSI and it's not an MACD and it's not a channel break and it's not a trend line break, what the hell is it? If it's not a doji candle, if it's not a spinner, if it's not an engulfing candle, what the hell is it then? Well, let's take a look. Let's change this up a little bit. I asked you to make a decision whether you're a buyer or a seller here. And the vast majority of you would probably struggle with that to be accurate and to give a good rational reason why you're a buyer or a seller, if you're honest. So let's change it up a little bit. Let's take a look at this chart, which includes some value lines. And interestingly enough, it's the same damn charts, but I've just added some value to it. Now, I want you to make a decision as to what you're going to be doing on these charts. Take a look. I've now added this red value line, which tells us which direction this market's going to be going. Now, what I want you to do is use this red line to try and figure out, forget all your other stuff, to try and figure out on the right-hand edge of this chart whether you're a buyer or seller. And you can obviously use a lot of your technical stuff to figure this out. You could use candlestick formations, you could use order flow, you could use volume, you could use exhaustion prints. You could use all the stuff that you've already learned in other classes to now put you into the right trade at the right price. Take a look at charts number 1, chart number 2, chart number 3, and chart number 4, and tell me whether you would be buying or selling. Do you see how simple the process of trading becomes by knowing how it works? Just for a change. These are all value lines. They're not cherry pick, guys. It's the last 24 hours. It's the last 24 hours. I haven't gone back 3 years to find great examples. So the first one, the market is bearish. It's still bearish. It's dropping at the right-hand side of the chart. So what is chart number 1? Would you all agree with me that you'd be trying to find a way into a sell trade? Would you all be happy with that outcome? Would you be trying to sell into that top edge, possibly even the bottom edge, on the basis of how this value is developing? In chart number 2, if the price always goes in the direction of the red line, would you be delighted? Would you be delighted to be a buyer of this bottom edge here and then this bottom edge here and work the bottom edge prices? Would that be the trade that you would absolutely be on board with? Well, perhaps yes is the answer. So this looks like a very, very definite buying opportunity at the bottom edge, doesn't it? So obviously so far we've managed to get a sell trade on the chart number 1, a buy trade on chart number 2. What about this one? Oh, damn tootin', this looks very bearish. We've came off a top edge. It's still bumping along the bottom edge. We certainly haven't got any big divergence off the bottom edge. It still looks bearish. Yeah, I think this looks more like a bearish trade rather than a bullish trade, just simply using the concept of selling order flow, selling values. It's certainly not bullish. So we should be trying to find our way into some top edge shorts. Perhaps a little break up to the top side here might be a great opportunity. Perhaps some toxic order flow as we drop back off this might be a great opportunity. Perhaps this little spring trade here might be a good opportunity to get some of that bearish sell trade. The candles go in the direction of the red line. And this one is probably as easy to recognize as this one. The two buy trades are so crystal clear, aren't they? So what is this? Well, just give me as much buy action as we can possibly get our hands on, Ray, please. If you don't mind, buy me everything you've got. Well, congratulations, guys. If you can now see the trades, this is all you need before you actually can become successful. Because once you've got this type of information, once you can start to develop out these ideas and these models, and we'll show you an S&P model from earlier on today when we talk about the two variable model that we're going to be teaching in the order flow class. Then when you can see what the trade is, I'm not telling you that you're going to get a buy trade here and it's instantly going to be a winner, but you're going to be on the right trade of the big banks. Not the commercial traders, not the market makers, but the big bank traders that are trading these values. In other words, you've got a probability edge that is now definable. It's quantifiable. A break of a trend line is never going to be quantifiable. You've got to be able to quantify what your edge is on every single trade you take. How is a head and shoulders quantifiable in probability terms, guys? It's impossible, isn't it? It doesn't make any sense. So if we know that people will buy this market, if we know that institutions will be buyers here, if the red line's rising, this is a no-brainer. It's just a deal. It's just get involved. Press the fecking button. You see the difference, guys, between this? See the difference between this and this? You see it? You see the difference? What does this tell us? It's got a top edge, it's got a bottom. So what's the point? Is it the divergence at the bottom edge that tells us that this is going higher? No, it's got nothing to do with it. It doesn't tell us anything. It tells us whether the price is overbought or oversold compared to the last period of X number of candles ago. What use is that? None. There's no use in it. So why do you use it? Why do you even look at it? Why the hell is it even on your charts? Because it doesn't tell you anything. It tells you nothing. Whereas this line tells us where the price is going to go next. It's dropping back off. We should sell the top edge. We'll make money. This line is rising rapidly. We should be buying the bottom edge here. We're going to make money. This line is dropping hard and fast. If we sell the top edges, we're going to make money. This line is rising hard and fast. If we buy these bottom edges, we're going to make money. And when we then look at what happens on the charts, once we have that information, you'll see that if we add the arrows to the charts, this is just the charts changing, of course, then obviously we knew that this was a sell trade, that we knew that this was a sell trade, because we've got the arrow in there. If you want to see the pattern, it is the same pattern. I haven't done anything fancy with the charts. I've just done exactly the same charts. So that's the sell trade there. You can see that that was a brilliant sell. We know that this was a couple of opportunities maybe to buy here and maybe to buy here. Has that turned out to be a good trade, guys? Yes or no? Do you make a couple of grand on it? Sure, absolutely. We know that this sell trade here, we've already highlighted the possibility of selling up here, maybe this little pullback trade here as well. Do they work out for you? Hell yeah, absolutely. Absolutely. See them? I'm not photoshopping it. I'm not changing it up. I'm not doing anything. I might be squishing the chart in a little bit, but I'm just trying to give you a picture of what's happening. I'm trying to show you how this trade develops. This bottom edge here is that bottom edge just there. This bottom edge here is here. So this does extend on a little bit. So you might have got a couple of opportunities and you might have had to work that a few times to get that short trade, but it was still a short trade. You'll see this balance area here with that beautiful value to the upside, very obvious bottom edge buy trade. And obviously when you look at the left-hand side of that chart, we get this enormous buying break to the upside, don't we? We already knew that this was going to be a buy trade, so our job was to obviously buy these bottom edges here, here, buy these bottom edges here, get ready for what we call the top right-hand hold, and there's the top right-hand hold, and there's the breakout to the upside. Is that not a huge improvement on your trading already, just by seeing value? Just by understanding and developing out an idea of value on any chart, on any market, and guess what? The value that drives the market is going to be different on every single market. And to find out what value is, you've got to start understanding things like the pricing of credit default swaps. You've got to start understanding the concept of the curve. You've got to understand the concept of spreads. You've got to understand these things that drive the market price, the things that the banks use to hedge positions. It's very, very important. How many other people, how many other classes have you done, have even talked about this stuff? It's very important, isn't it? Let's carry on. Let's carry on, guys. I'm babbling on here. So let's get through this little slideshow. Think you can choose your own hours? Well, we'll get through this really quickly. Well, of course you can. However, if you want to catch the big moves, you can't. Trading direction is not random. It's designed. Accumulation and distribution. Mark-up and down phases are all designed and executed with pre-planned scenarios and strategies. All large traders need huge volume. They're not price sensitive. However, they are volume sensitive. Not just on entry prices, but also on exit. At a bottom tick price, there might be 10 lots available. I need 1,000 lots. So I'm not going to be worried about that bottom tick price, guys. I need to get my volume filled. I need to get 1,000 lots in that market. You read earlier about the guy that was trying to sell 75,000 S&P contracts. I also need to know where I'm going to get that volume off at the top edges without running price straight back down against my entry price. So I need to be able to identify pockets of liquidity at higher prices where I'll be able to find buyers at those higher prices. Perhaps a hedger might be up there, perhaps some stops might be up there. Perhaps it's a big wholesale price level. So in index futures, big traders will deal at the US Open and the US Close, for example. In the index markets of the European session, they'll deal at the Frankfurt Open and, more importantly, the London Open at 8 o'clock in the morning. So we need to be available in the retail space. You absolutely must be available at these times if you want to catch the big swing trades. It doesn't mean you've got to sacrifice having a lie-in the morning every now and then. It doesn't mean you can't trade the US session. Of course you can. It doesn't mean you can't come in at 11 o'clock, but just be aware that if you come in at 11 o'clock, we're probably exiting that trade whilst you're entering, and it's probably just going to be a pretty crappy 10-tick trade. So here's the problem for everybody. Do this course and you will become an amazing trader. No, unfortunately, like everything else, that will all depend on how good you go about applying the knowledge that you gain from the course. What I can say with absolute certainty is you'll be a better trader for doing this course. You'll appreciate the incredible complexity of the trading world and why so few traders actually succeed, because they're too narrow in their focus. If you pass a medical degree, will you be a great surgeon? Possibly, you might be. You might develop into a great surgeon after your traditional 10,000 hours with a scalpel in your hand. Or you might be a terrible surgeon. You might end up turning into a telephone salesman. Or do you do a golf class with Tiger Woods and expect to play in the PGA next year? Probably not. Some will probably become very, very good. Some might be, good but not very good. They might manage to take a couple of points off their handicap. But it doesn't mean that by doing the course, you're going to become a great golfer. You're going to be better. There's no guarantee, guys. It's all about how much work you're willing to put in. And when I say work, you've just seen a simple chart there, guys, with one line. A lot of people think this course is going to be too much work. There's a lot of information in it. But guess what? See, when you apply that one single line, have you not already simply improved your trading immensely? From trying to trade off a stochastic that you wouldn't have been able to find any trades, or a trend line that wouldn't have given you any successful trades except for the very last one. It's given you 4 or 5 losing trades in a row, and then it gives you a big winner, and that's the one you keep on boasting about, even though your account's losing money. Or the second series of charts where you've got the actual value line that tells you which direction the market's going to move. Already you've managed to get a huge advancement of what you have been able to learn in the past. Huge advancement. So some of you will get a lot better instantly by learning one single thing in the marketplace. And all you've got to do is develop out that knowledge. So let's take a look at what we're going to be looking at inside of the actual course itself. In week 1, we're going to be talking about equities and order flow. We're going to be talking about the equity indexes. We're going to get up to speed on those. We're going to talk about the market maker pricing of equities. We're going to talk about stock trading. We're going to talk about event horizons, short-term volatilities, long volatility, trades. Why are we interested in long volatility trades? Commercial interests. We're going to talk a little bit about gamma scalping. We're going to talk about the prem. We're going to talk about market internals. Trade whilst you learn, with a bolt-on option of equity plays inside the support site, which is Smart Alpha. So if you wanted to get actual trades in terms of equities, then obviously Smart Alpha would be another option. It doesn't have to be taken. There's no requirement for you to take it. But if you want to get some of the trades that actually can earn you some money during the course of the course, then obviously that gives you a possibility. And we'll show you how some of those things have done. In terms of the order flow in week 1, what we're going to be looking at is the useful tools. The market maker's order flow model, for example. We're going to be covering an interns exercise that we do in the bank on a regular basis every time we bring in a new series of interns. We look at the ability to chase liquidity. We talk about L1 liquidity or L2 liquidity. We talk about market maker toxicity. You will learn the basics of how an intern sitting on Goldman's learns how to trade. It's not the best trading style in the world, but it starts teaching you about this concept of liquidity and volumes. What we're going to also teach you in week 1 is how to build a simple but effective directional model for your short-term order flow and apply it into the US index markets and into the index futures. It's applicable to the S&P as it is to the Nasdaq, as it is to the Dow, as it is to as it is to the Russell. We're going to teach you about exhaustions, absorptions, volume analysis, market profile, price action, liquidity order book, large orders, BSG squeezes, footprint charts, and market deltas and the whales, all inside of the first week. All inside of the first week. And you don't have to do anything beyond this week to become a successful trader. If you want to trade in the stock market, if you want to trade some options, if you want to trade long volatility and you want to trade the index futures, you could actually end at this point. And you would actually be very, very significantly in advance of where you have been in the past. Now, obviously, one of the key aspects here is that, well, what else can we make from this? What else can we look at? Well, take a look at this little chart. This is a traditional chart of a trading style that perhaps is adopted by a mutual fund or a pension fund. It has the 50-day moving average on it, and it's just the S&P going back to 2018. Now, the rules for this S&P going back to 2018. Now, the rules for this S&P trade are very, very simple. And guess what? This is crazy. A lot of you probably hire firms to manage your pensions that use something as garbage as this. No wonder your pension's underperforming. Because when a market doesn't go straight line up, you start struggling, don't you? Plus, they take their commissions off it. Of course, they take their management fee. But let's assume you buy when the price crosses and closes above the 50-day moving average, and you exit when it crosses back below. Let's assume that's the trade. Well, during 2018 through to 2019, in terms of stock indexes, there were 12 trades. Numbers 1 to 4, numbers 5 to 6, numbers 7, 8, and 9, 10, 11, and 12. You can see where all the arrows are. Out of those 12 trades, 9 were losers and 3 were winners. Just 3 were winners out of those 12 trades. Now you might be saying, yeah, but the winners that we did get, trade number 7, trade number 9, and trade number 12 were all winners. And they were good winners. And it depends, therefore, on the money management of trades 1, 2, 3, 4, 5, 6, and 7. It depends on the money management of the losers, doesn't it? Well, yes, it does. So let's assume that the money management was a 2% stop. And there's some of you have probably experienced significantly more than 2% stops on some of your order flow, or some of your pensions, in fact, that have dropped by perhaps 10% and 5% during some of these big corrections. Well, let's assume that they're using a 2% stop. Let's assume also that they're having some sort of upside target that is reasonable against that 2% stop. Well, guess what, guys? If you started with $20,000 at the beginning of 2018, and you followed this strategy with a 2% stop, and in addition to which, you top ticked the exit on the 3 winning trades. So we're not giving you a bad fill, we're giving you the top tick on trades number 7, on trade number 9, and on trade number 12. We're giving you the top tick exit and a 2% stop on the other trades. Your $20,000 at the present moment would be worth $19,975 less commission. In other words, you'd have lost $25, even by giving yourself the top tick price on that chart, even by following that simple pension fund or mutual fund moving average line, 50-day moving average. It's a very simple, basic strategy, guys. I'm not saying that it's not. I'm not saying that it's complicated. I'm not saying that there are pension funds that use something as basic as this. But guess what? There are, unfortunately, several that use something as basic as this. It's just a passive way of getting into big trends. And see, when it does trend, they're in it from the start of the trend and they're all the way through to the top edges. But see, when it goes into a market like this, guess what? You're in real trouble. You're in real trouble. And that's assuming, of course, that the exit on the downtick back through the 50, they might hold. So guess what happened to trade number 10? Holy moly, your account didn't just lose 2%. If they buy and hold, you've just lost maybe, bloody hell, you've just lost 280 down to 230, guys, 240. You've just lost a lot of money. You've just lost a lot of money, haven't you? You've lost 40 full points on that drop from 280 to 240. Enormous loss on that trade. if it was a buy and hold strategy, and especially if they'd leveraged up that trade and they were now in real trouble, you could find that your whole account was wiped. So what's the solution? Finding value, guys. That's what the solution is, finding value, and we'll show you a couple of examples about how we go about finding value. And we're talking about stocks here because we're talking about week 1 of this course, stock markets and order flow. Here's one of the ways we find value. Stock buybacks can increase shareholder value. Stock buybacks raise the value of a given stock holding in 2 ways. Number 1, a stock buyback raises a company's earnings per share. It's simple arithmetic. Buybacks reduce the number of shares outstanding. In other words, the float drops. To get earnings per share, you divide the total earnings by the total number of shares. Well, if the total number of shares drops, guess what? Your earnings rise. And guess what happens when the earnings per share rises? Price generally gets bid up. Generally gets bid up. When you reduce the divisor, because the company has fewer shares outstanding due to stock buybacks, the calculation gives you a higher number of earnings per share as an answer. A lot of algorithms trade increases in earnings per share. They will buy companies where earnings per share is rising, and therefore there is going to be a natural buy side tendency when we get a stock buyback. On the whole, buyers are willing to pay slightly more, and as I've just mentioned, algorithms will start buying these types of stocks. Secondly, when the company engages in stock buybacks, it bids up the price of the stock itself. Now, obviously, that's interesting. It doesn't mean the company's a great company, by the way. It means it's got a lot of cash. It might be borrowing for the buyback, but it's probably got a lot of cash. The challenge you've got on the long term is it doesn't mean it's found a better way of operating. Usually they don't do buybacks if they found a better way of operating. It means they've got too much cash. In other words, they're maybe a little bit stagnant in terms of their growth, but you're going to get that short-term pop on price. Well, take a look at these statistics that are just coming up, guys. Take a look at these. Remember, we've just looked at 2018 to 2019 using a 50-day moving average in terms of the way that pension funds trade, and we've identified that $20,000 results in a profit of nothing after a year of holding on to those types of trades. Well, let's take a look at what happens here. Take a look. On the left-hand side, you'll see a date. You'll see a ticker symbol, and you'll see a percentage. And one of the things you'll be able to see is that from the 24th, you saw that the first stock that we chose was a company called LRCX, made 21%, HAFC made 8.8%, CZR made 8.1%, all the way through to the very bottom one. If you compounded each of those trades, the one thing you'll be able to see is that there were no losers. There was one scratch trade, FitB, made no money whatsoever on trade number 1 and made 5.3% on trade number 2. If you compounded every single one of those trades, and you can see that there are not a lot of trades, but bearing in mind this period is only 6 weeks. This is a 6 to 7 week period. $20,000, if invested in each of those stocks, and bearing in mind that there were on occasions 2 stocks on one day, and therefore the money would be split in half, then you would have turned $20,000 into $37,258, probably maximum. Probably maximum. It depends on your own money management, guys. It depends upon how you manage it, but this is possible. Now, obviously, when you look at these types of trades, you'll see that there's a couple of tweets. And you might be saying, yeah, but do we get to know about these stocks before they happen, or is this yet another hindsight trade? LRCX, repo, might not get any value, but watch the pre-market open for opportunities. As soon as we put a stock like that, it's a buy. It's never a sell trade. It's never going to be a sell trade. It's always a buy trade, so that you know. You might be saying, but you never said it was a buy trade. It's always a buy trade. Unless we say long volatility or long vol, it's a buy trade. LRCX, look at what happened. Look at the time of the tweet, 12:29 a.m. on the 24th of January. In other words, that's the London time. 12:24 in the afternoon, just after lunchtime. And obviously you can see here, it's before the market open. That's the most important thing. It's before the US market open, 24th of January. And you can see what happened. The price opened gap up and then exploded to the upside for 21% gain on that. That's non-leverage, by the way. That's not options. That's not CFDs. That's buying the actual physical stock. The next trade was WWW that we've put in here. It's at 1:57 p.m. In other words, It's from the 12th of February. It's a half hour before the US cash open, half an hour before the US cash open. WWW announced a repo buyback. However, news was out yesterday. There was some inside information. Somebody bought some stuff before that. But the market opened gap up. We got a good value trade. The price rallied and then rallied up to close. And we managed to make a very, very nice profit ahead of earnings. And we took the profit out on WWW for a profit of 5.8% gain. And that, again, that's non-leveraged. It's short term. A lot of these trades last one day. And that's it, one day. Perhaps some of the trades even last less than one day. Perhaps they last for 40 minutes. You might be saying, 40 minutes, are you kidding me on? Well, let's take a look. Take a look at this stock here. You'll see the tweet just here. It's at 1:23 p.m. London time, 1:23 p.m. You might be saying that's not a lot of time to get the trade on the basis that the hours have changed and therefore this is, but it's still 7 minutes, guys. 7 minutes before the US cash open, we had a look at this. I felt it was a good trade. It was a company called BCOR. We bought it on the open. We called this trade in the room before the market opened. We bought it on the open. And by the time 40 minutes had passed, we bought it at $30.60 on the open. 40 minutes later, we exited at $34.20. That was a gain of 11.7%. 11.7%, guys, in 40 minutes. You're not exactly massively exposed to movements in the stock market now, are you? You're not exposed to huge corrections if the market starts collapsing into a heap. We actually gave a signal on General Electric. And you'll see the signal actually. You'll see that trade on this chart here. You'll see on the 6th of March, we've got Brexit on our mind here, guys, over here. Anyway, GE, General Electric, we gave a signal there on the 6th of March before the market opened. We says be a buyer on downticks. The market, the stock market, the index was falling like a stone at that stage. If you check back on your charts, we gave a signal to buy General Electric and the stock market was falling like a stone. General Electric rallied by 11%. Never went a tick against us. Never went a single tick against us from the open, and we made money. Now, how do we see these trades? Well, there's a lot of different ways. We look at different ways of looking at the market. We have a reason. There's an event taking place that we want to take advantage of. Short term, hit the market hard and get back out again. And that's got to be a winning strategy. It's got to be. It's not buying 5 cannabis stocks and holding them for 10 years and hoping for the best, or buying some crazy Bitcoins at $20,000 per coin and then seeing it dropping down to 3. It's not buying the next hot 5 picks and holding them for the next decade and hoping they go up because they've got great tech. It's about getting in and getting out, guys. If you look at the performance of that over 7 weeks, it's went from $20,000 to $37,000. It's nearly 100%. Every single one of those trades was tweeted before the trade happened. We haven't missed any trades out. We haven't photoshopped any of them. They were all on the tweets before they happened. There wasn't any more. There wasn't any less. This is it. This is all the trades we've shouted. And you've seen that. You can see the results. I'm not saying you're going to get exactly the same results, but if you decide to act on those, and that's a big question, that's up to you guys. That's not my shout. We're just giving you the scenario. If you decide to act on it, the possibility was there. You would turn 20 into 37,000. The possibility was there. You've just seen today's trade. By the way, that trade there was today's trade. You can see the date on it, 19th of March, 1:23, 7 minutes before the US Open. 7 minutes. This was the outcome. Boom. Top edge was called, and we got out of that trade at 11.7%. You might be saying, what happened to this other one? Well, the reason why I never showed you it is because it never made any money. Didn't lose any money, but there's a bit pointless showing you. It was a zero. It was a scratch trade. It went up, it came down, scratched us out, we got off the trade. Simple as. So that's how it deals. We don't take any risks. We don't take any drawdowns. If we make some money, we're good. If we don't make any money, we just close off the trade very, very quickly. We take a zero and we walk away. Simple, clean and effective, and we'll teach you how to get into those trades if you decide to come into the room. What else do we do in stocks? Well, let's take a look at this one. These are long volatility trades. These are all equity-based. These are all equity option-based trades. And the trades on the left-hand side actually are all expiry for the 15th of March. These are all trades that have just expired. The ticker symbol is on the left. This isn't all the trades this year, by the way, guys. This is just trades that expired on the 15th of March, the most recent expiry ones. The ticker symbol on the left, the second column with the minus sign, is how much these option trades cost. And the third column, which has got all pluses in it, is how much these options actually made in net profit after the cost is deducted. You can see WY made $390. The cost was $200 per option. Now, when we're talking about long volatility, we're talking about buying a call and buying a put and straddling the marketplace. You can see that the TSG made $225 net profit. APA, Apache, made $700 net profit. KDP made $180. And obviously, it'd be up to you if you take any of these, take none of them, apply different percentages to each. But take a look at the bottom two. Roku and Garmin, GRMN, ticker symbol Garmin, GRMN. The cost was $400 for a call and a put at the money, straddle. And this was an expiry of the 15th of March. That trade made us $3,000. You might be saying, nah, it didn't. No way did that trade work for you. $400 was the cost, and you made a net profit. In other words, we took $3,400. $400 cost off the top edge leaves us with $3,000 net profit. Well, let's take a look, see whether we did or whether we didn't. On the left-hand side of the chart, you'll see the original tweet from the 21st of February. 3:46 p.m. So the US market's already opened. The US market's already opened, but it is open, so you can get the same trade. You can go into the markets, Roku earnings volatility, short-term straddle, bearish skew, don't overpay, and obviously we were taking the next expiry, which in this case was going to be the 15th of March. Well, the chart on the right is what happened next, after the tweet. After the tweet. And these arrows are what is called gamma scalping. And a lot of people talk about gamma scalping. We've got a very simple process for gamma scalping. We get the options and then we sell 100 shares against the option. We don't drift into these or drift out of these. We simply sell 100 shares or buy 100 shares. And you might say, yeah, what happens if you can't get short stock? Well, obviously you don't understand the concept of synthetic shorts, because we can obviously get a synthetic short stock at any of these top edge prices. So we sold this one here. We sold this one here. We took another 100 shares short here. We scratched that. It's zero. You can see here that the first two trades, in fact, were both scratches. The total cost was $4. In other words, $400 per straddle. $400 per straddle. So where we've got this strike price, that's the strike price that we agreed, the 52 strike, plus $4 to the upside, takes us up to 56, plus $4 to the minus $4 to the downside. This is our volatility area. So this is where we would lose money. If the price doesn't go outside of this area, we would lose money come the expiry date. If the price does go outside this area, we obviously make lots of money. And you can see that the stock went up. We took zero in the first trade, zero in the second trade, $3 on the third trade, $1.50, zero, $3.50, $4, $14, and $8 when the trade finished. You can see that the $52 stock rose to a maximum of $74. That's a $22 profit on a $50 stock, guys. That's pretty damn tootin' good if you were just taking this as a directional bet, wasn't it? Pretty damn tootin' good. Anyway, taking it as an option, you can see that the total take was $34 or $3,400 on that one single option, and the cost was $400. $400 on that option, guys. You walk away with $3,000, and the period was 3 weeks, 21st of February to the 15th of March. 3 weeks to make $3,000 in profit. And you can see the tweet, it's time stamped so that you can see exactly when the tweet went out. You would have been able to get exactly the same trade, give or take a couple of cents on those options, of course, when you go and price it. And that's how the trade works. Perfect, isn't it? Perfect. You might be saying, yeah, but Ray, one of the things that we're interested in is not just these types of trades. We're interested in other things. We're interested in some of the other elements that the big course can bring. Well, let's kick on and get this thing finished. So when we talk about this, for a small monthly fee, you'll be given these scenarios in advance. I mean, this is just an additional bolt-on. You don't need these because some people might already be active in the options markets. Some people might not have any interest in trading the options markets. So we don't include it as a standard. It's just if you want it, it's there, and it's a very small fee. It's actually only $50 extra per month if you want them. And you can see that one trade just made $3,000 on that trade there. And today's trade, which was for 40 minutes on a $2,000 account, made $234 profit. You'll be given these scenarios in advance, and you can cancel obviously those at any time. How you manage these trades is at your own discretion. However, we'll show you how you can key away some of the analysis into these index markets. In the order flow class, we'll show you the quality spread and deal with some important market internals. We will cover the prem, for example, what it is and how you can use it. It can be quite useful. We'll show you how the tick is actually properly used, how to look at puts and calls, and how you interpret the movement of the puts and calls. We'll talk about the highs and lows, amongst other things. If you progress into the full course, we'll expand on these principles when we look at some of the other markets like the dollar itself or the dollar forex crosses, the bond market, the curve trades, the CDS risk line. So when we move beyond the order flow in the equities and we start talking very quickly about the full course, we'll show you a couple of examples here of what's important. The full course, time to learn why. Trade and earn with the equity plays, obviously. So obviously one of the things that we've been able to establish is if you decided to go with that equities, if you decided to trade the equities, by the time you finish the course, you could have paid for the course from the equities, assuming you start with a decent size account of $5,000 odd. Fundamentals, what are important? We cover why they're important. We cover what's important. We cover the pre and post data trade opportunities. We talk about contango and backwardation. We understand the supply and demand that's coming into certain markets. It's not just about Forex. Technicals, why are they important? Well, we can tell you some incredible market structural situations. We'll talk about God's own chosen ratio, not Fibonacci, believe it or not. But we can talk about some market structure which has got an incredible accuracy. And the guys will sometimes they just scratch their head and say, oh, bloody hell, that was pretty damn good. We talk about bank targets. We key off of wholesale price levels. And we can talk about accumulation and distribution. We talk about market profile, why it's important. We talk about Forex markets, what makes the Forex markets move. We can talk about trade setups in every single time frame, from 1 minute charts to daily charts, all the majors. But once you understand the framework, you can obviously trade any Forex pair. It's not specific to the pound dollar or the pound yen or anything like that. Oil, we talk about oil in the futures markets. We talk about the key drivers. We've got a lot of oil traders and they are good traders. We talk about the key drivers. We've got a lot of oil traders and they are good traders. We talk about the oil drivers. We talk about inventory levels. We don't talk about overbought and oversold stochastics, guys. We talk about real things. We talk about the Brent WTI spread and how that's impacting on oil prices. We talk about the crack spread and how that's driving oil prices in one direction or another. We talk about other key drivers in oil and we talk about the trade setups. When we move on to the bonds, and people kind of glaze over when we move on to bond markets, we talk about the curve. We talk about the front, the middle, and the back of the curve. We talk about the curve in terms of twist, in terms of parallel shifts. We talk about simple directional trades, the spread trades, the impact on everything else that the bonds have. When we talk about ags, we talk about soybeans and wheat. When we talk about other commodities, we're talking about things like gold. We also talk about natural gas, how to trade like a pro, and we talk about things like the Widowmaker. You might not have heard of it. You will be by the time you finished. And when you finish the course, you'll also be aware of charts like this. You'll see a chart like this and you'll say, I know exactly what this is. No, it's not a price chart, guys. It is not a price chart. It's a very, very important chart when we look at natural gas. We can obviously look at things like structural weakness against what we call the inventory level. We can obviously look at the short-term swing trade. We can look at the back-end adjustment, which was bullish in this case. And we can obviously look at whether there's structural strength or structural weakness in the natural gas market, just like a professional natural gas trader. We're a decent sized trader in the natural gas market. So we didn't used to be, but ever since I took an interest in it, we've been getting more and more support from the bank to put more and more money into these particular trades. And believe it or not, we got in before the massive run up in natural gas a short while ago. I can't even tell you when it happened. It was quite some time ago. I can't give you the exact date, but take a look at your natural gas charts and you'll see this huge run up on natural gas. We got in before that happened because we saw something going on that I really caught my attention and caught my imagination. And we were able to get in on that. In fact, we tweeted about it before it even happened, guys. Not hindsight, before it happened. You might be saying, okay, well, does this apply to everything? Does this apply to some of the other markets, for example? We'll take a look at some of the tweets we had on Brent WTI spreads. Not the most common trade, but take a look at these tweets. The first tweet was on the 15th of March at 1:21 p.m. 1:21 p.m. Take a look at the bottom of the chart here. You'll see a timestamp on that chart. 15th of March, 1:30 p.m. Tweet was at 1:21 p.m. 15th of March. So effectively the same place on the chart right here. Take a look at what the tweet says. Brent WTI back in a long trade after yesterday's plus 10 minus 10 scratch trade. Okay, so we don't hide anything. We don't gloss over anything, guys. We don't delete things that don't work out. Yesterday's trade was a plus 10 minus 10 scratch. We made 10 on the first trade. We put a stop at minus 10 and we lost the minus 10. So we ended up scratching the trade. This morning, you can see the timestamp of the tweet was 1:21 p.m. and we can tell you we're back in a long trade. So there's where the trade is. Where the arrow is where you, as a trader, would have been able to take this trade. We'll take a look and see what happened next. Take a look. The price went straight north for $550 per contract, or sorry, should I say per spread. And then we see the second tweet. Brent WTI still buying at the lows, 11:26 p.m. on the 18th of March. And then at 10:14 a.m. on the 18th of March, Brent WTI still long, no change to that this morning. So in other words, we bought here, we tweeted what we were doing, and what happened next? The trade went straight up, $250. Add those two trades together, guys. Two trades in 2 days, $800 per spread. Now, what's difficult about those? Take a look at the green line in the background and tell me that green line doesn't tell you exactly where you should be trading. Take a look at this incredible bid that comes in the green line here and tell me if that doesn't tell you should be in that trade for $550, guys. Tell me that the divergence in the green line at the top edge doesn't tell you to get off that trade at the very top edges here. It's perfect, isn't it? It's absolutely perfect. You'll learn what the green line is when you come into the classroom if you want to learn these things. You'll learn about the green line. You'll learn about oil, Brent, WTI spreads. You'll learn about DAX, FTSE. You'll learn about the S&P. You'll learn about the crack spreads. You'll learn everything you need to know about trading. Everything you need to know about trading. You might be saying, okay, well, I don't think I'll ever trade any spreads. Why the hell not? Why shouldn't you trade spreads? Okay, you're not going to trade spreads. Let's take a look at this bond trade from today, in fact, surprisingly enough. Take a look at the bond trade from today. I want you to pay attention to the tweet I sent out last night, guys, at 11:45 p.m. London time. So in other words, after the US market's closed, before the London market opens, it's midnight London. 18th of March, so it's just before midnight London, okay? Take a look at what I've said. Bonds. Saw the first real short bond grail trade this afternoon versus Zabelli as discussed with you today. We were effectively, see this big shaded area on bonds, we were sellers off of that shaded area for a very simple reason. You'll learn that reason in the room. You'll know why we were big sellers off of this price. And take a look at what happened today off of that same top edge. This, believe it or not, is where the bond dropped down to. It was nearly $1,000 per contract. It was actually $970 maximum per contract on that short bond trade. And yet you had yesterday. We don't often buy and sell a market. We're normally selling a market or buying a market, and that's it usually for the day. Sometimes we do have a couple of swings. But on this occasion, we were simply selling into that top edge. We got what we call the grail short. Sounds a bit corny, but it is what it is. It is actually the grail of trading, the holy grail of trading, when we can understand what's going on in here. And you'll understand that if you do the full classroom. But you'll be able to get this trade. You'll see this trade. You'll know why this trade exists. And whether you make $1,000 or $500 out of this trade, that's more up to you, isn't it? We did about nearly $1,000. If you get greedy, you wait for $1,000, the price actually bounced really hard and fast off of that, but there's a very simple reason for that. For several days, we've been calling buy-side equities because of a certain pattern that was forming on the curve itself at the belly. And a lot of the guys know this because we call it every single day in the room. We talk about it. We talk about the curve shape. We talk about the front end and the belly of the curve. We talk about the back end of the curve. Does this not sound like something that's completely different from what happens in the retail space? In other words, every day you're going to be exposed to the institutional world of trading. It's not how to move an algorithm about. No, it's not about how to put a change in your trade settings of a stochastic, of changing it from a 5 to a 15 period. This is what happens in the banks every single day. And you're going to be exposed to that for as long as you decide to stay in the room. Every day we talk about it, every day we show it, every day we challenge people to try it again, to get it right, to do it again. And this is what's important with this whole process, isn't it? This is what's key to this whole process, is being able to use this information and say, you know what? I can do this. I can make sense of these trades. So it's up to you guys. There's no hard sell. I'm showing you what we do. It's not easy. It's not that difficult. You can do it one line at a time. That's all you have to do is one line at a time. You'll learn every single driver on every single market. If you just come in for the short course, you'll obviously learn how to develop out ideas about the two hypothesis model. And I'm just going to touch on that, and I'll finish on this actually. I want to just show you the two hypothesis model about how it traded today. How it traded today. So I want to just take you into the S&P. Okay, very, very quickly. I want to take you into the S&P here. And this is today's S&P on a 1 minute chart. You'll see lots of arrows. You'll see lots of arrows on the chart, sell side arrows, buy side arrows here. You'll see some sell side arrows here and a big exit here. Now, obviously, you might be looking at it saying, okay, well, they look, pretty good trades. Well, yeah, they were pretty good trades. Every single one of them was a winner. There was one scratch in amongst all of that, but every other trade was a winner today. And you can obviously look at the top price was 58. The bottom price was 30. So guess what, guys? 58 down to 30 for that sell trade, which lasted literally from 1600 hours all the way down to almost the close. It's a pretty damn good trade, isn't it? It's nearly $1,500 per contract. $1,500 on a mini S&P contract, single contract. $1,500. Is it possible to make big money when you're trading? Absolutely. You might be saying, okay, well, that's all very good, but how did you get that big arrow up there? How did you even get this sell here or this sell here or this sell here? It's based on the two hypothesis model that we're going to teach you in the room. If you do the short course, you're going to obviously learn it if you do the long course, plus a lot more. But if you do the short course, you're going to learn this model. And the model is based around a couple of very, very simple parameters. The first line, and you'll obviously learn what these lines are. You'll learn how to put them on your charts. You'll learn what they are. You'll learn why they work. But let's take a look at the first line. The first line is this line here. Well, let's try with the other line first. This is the first line that we want to look at. Now, it doesn't look like much. It doesn't look like much. It looks very, very noisy. It looks very, very spiky. And you might be saying, how does that give you any buy and sell trades? Well, it's about the relationship of two lines. It's the relationship of the red line and the relationship of the purple line. And as I said, if you come into the classroom, you'll learn what these are. You'll learn how to construct this, and you'll learn how to use it in conjunction with order flow. It's a very, very simple model, but it's a very effective model. It resulted in those arrows, for God's sake. So let's take a look at the other line. And I'll give you the rules before you look at this. The next line is going to be a pink line. And the basic rules are very, very simple. If the pink line is above the purple line, then you're generally going to be looking at it as the pink line will always trade towards the purple line, and if it trades towards the purple line, the price will go in the opposite direction to the pink line. So let's take a look at the pink line. So you can see, for example, during the early stages of today, you can see the pink line is well above the purple line. So obviously what's going to happen is the pink line is going to trade to the purple line, which means we should be buying the bottom edge. It's not as random as it seems. There are actually more rules to this once you start learning concepts of liquidity and levels and order flow. And you can see quite clearly that by buying into the bottom edges here, it's a very obvious trade. There's no question about being a seller. There's no question, because the pink line is quite obviously well above the purple line. It doesn't matter how we scale it. It doesn't matter how we dice it. The pink line is above the purple line. And as I said, if you come into the classroom, you'll learn what these lines are. Now, these becomes very simple, obviously, buy trades, and you can see we get this beautiful rally. However, you can see at this point here, where the big arrow is, that the pink line actually makes a new lower low. Now, in terms of scaling, at that point on the chart, the pink line is actually making a low, and the purple line's actually just made a new high, and it's just came off that new high. So obviously, in that type of situation, I become a seller of the S&P. You might be saying, was that true? Well, let's take a look. If I take you along to the far right-hand edge of the chart at that point where that arrow is, and I zoom on if I zoom in on this purple and red line, you can see very obviously, even when I zoom in at this stage, you can see the pink line is well above the purple line, so these are still buy trades. You can see at this point, the pink line is significantly below the purple line. And this is a very, very significant order flow price level, by the way. It might not seem like it to you because it's priced at 58s, but the guys in the room will know that this is an incredibly powerful level for us to sell the S&P from anyway. So when we see that pink line at a significant discount to the purple line, we know that this is going to be a top edge sell. A little bit of difficulty getting your head around it first, but at the end of the day, guys, for God's sake, it's only two lines. If the pink line has to go up to get to the purple line, it means the price has to go down. If the pink line has to go down to get to the purple line, it means price has to go up. You might think that sounds bizarre, but it results in these arrows. It results in these arrows. Take a look at the second half of the day. Which direction is the pink line against the purple line? The pink line is always making new lower lows. It's always making new lower lows. The purple line is making higher highs. So the only trade that's authorized is short trades. The only trade that's authorized is short trades. And you can see that that lasts all the way through the process until eventually we get this enormous sell-off, and then you can see the pink line rises as the purple line makes a new low. That's it. That's the trade finished. And everybody in the room will know that that is a massive exit price right here. And that's exactly where the price bounced off of. It's not a surprise. It's not hindsight. It's not cherry-picked. This is the reality of trading. This is the reality of trading in this room. It's real. It gives you confidence. It gives you confidence that you're on the right trade at all times. If I tell you, if you've got to trade the pink line to the purple line as a sell or a buy, you've got no question about what's happening here. It's got to be a sell trade. Your job becomes very simple. Find the damn trade. Find the order flow. Find what you're looking for to get that trade on the books. Is it stopping volume? Is it a rejection? Is it a reversal in order flow? Get on those short trades and make some monies. We'll show you ways to do that all the way from the start to the finish. We'll show you in the short course how to build this little model. And it's an absolute cracker. It's constantly making money. Constantly making money. It doesn't guarantee you're going to make a profit. That all depends on your entry and your exit, of course. But we'll teach you how to make the most effective use of entries and exits in the short course, and obviously in more detail in the full course. Anyway, I hope that's of interest. These are real charts with real information on them. They are used in the institutions every single day. It's not some made-up stuff. It's not about candlesticks. It's not about volume. It's not about market profile. It's not about Fibonacci. It's not about Elliott wave. Isn't that something really positive, guys? You can finally cut through all of the noise and learn everything there is to know about trading in one place without doing anything else. Everything there is to know about trading, guys. And if we don't know it, it's not worth knowing. So it's up to you. If you decide to take ownership of your own trading and stop passing it off to something else and stop making excuses for your own trading. If you decide to take action, then we're obviously going to be on the other side of this room waiting for you to come in and, we'll get started with you. It's not formal. We talk, we laugh, we crack jokes, we talk about food. Kim talks about food. Kim talks about wine. We talk about life. We talk about politics. We talk about economics. Sometimes you might like what I say. Sometimes you might think our jokes are rubbish. But you'll get to know us. You'll get to know us very closely, and you'll get to know whether this stuff really works, guys. And the guys in the room, some of the guys in this room have been in there for forever, for literally forever. Came in the Stone Age, and they're still here. You might be saying, well, why if they're successful? Because that's why they're still in the room, because they're now successful. They come in because they want to laugh. They want to find out a little bit more. They want to learn a little bit more. They want to suck every ounce of information they can get out of the room. That's why they're still here. That's why they're still working. Some of them are still working towards a target. Some of them are still working to get better every day. I'm still working to get better every day. I am not somebody that's been in the markets for 5 years and decided to start teaching. I'm not even somebody that's been in the markets for 20 years and started to decide to teach. I don't even teach full time, guys. This is a hobby. I've been in the markets nearly 40 years. 40 years of this stuff. And that's what we're passing on, is that 40 years of knowledge from the trading floor, from the brokers, from the market makers. We've been on the life floor itself. We've been in the oil pits in London. We've been in pretty much everything. I've been involved in some way, shape, or form in pretty much every aspect of trading over those 40 years. If you want to actually finally get the final location that you need, plus earn some money, hopefully, no guarantees on that front. You know, we can always not, you know, we've got 100% win rate so far, but it doesn't mean you can't lose on a, specifically on a stock buyback. It's just, it is what it is. But obviously, if you want to take advantage of those types of things, if you want to get into the one place and the only place that you ever need to go to find out everything that's going on, then this is it. This is your final destination. This is your final home. Nowhere else will tell you anything better than what we're going to tell you. They might go into other detail in terms of candlesticks or volume, but they will not tell you everything you need to know. They'll tell you bits. And that's why your jigsaw is always seemingly incomplete. Looks as if it should be good, turns out not to be so good. Why? Because you're missing pieces of that final jigsaw. This is where the jigsaw puzzle finally gets made. And it's up to you whether you then go ahead and take advantage of it and start using it and you start becoming a better trader, or whether you're going to spend the rest of your life looking for that holy grail setting on your indicators. Make the choice, take ownership of it, and I'll pass you over to Kim to then wrap this thing up. Thank you very much for your time. It's been a long session, I'm sure, for some of you guys in London session as well. It's 20 past 2 here, so we better get wrapped up, guys. Some of the guys are in London, and they're obviously going to start keeling over very, very soon. And we start working just 4 hours, so I better get finished. Thank you again. I'll say adios amigos, arrivederci, auf Wiedersehen, and spasibo.
Thank you so much, Ray. As always, good stuff. I know guys are like, just tell me where to sign up, please. Please, please, please. I'm going to take Ray's charts away and we're going to go back to why. I told you guys it was important. Ray is the man. He absolutely. And the one thing that for those of you sitting here asking, about it, everything you need to know, you should have just been looking in the chart. These are people that are paying Ray money and they're the ones telling you this is the real deal. Anyway, here's our spring training trade schedule. So we're going to be starting officially on Monday, April 1st, and we're going to be going through, now this is the full class, through May 3rd. So the first week we're going to have institutional order flow in the equity trade program. Second week you saw everything he was covering on fundamentals and technicals. Third week bonds and currencies and the FX markets. Then we're going to have crude, index, and ags. Then we're going to do a full week of wrap up, the institutional trade process. And many of you were asking, but I only trade FX. Maybe in my open, you didn't hear me, kind of talking about this. That was kind of what I kept saying. But Ray, I don't want to talk about bonds. I don't want to talk about all this other stuff. I just do currencies. I only know currencies. And then I realized how much I didn't know and how important, since yields drive everything, you have to know. So if you trade FX, this is probably more important to you than people that trade other markets, just about because you're going to get the information that you really need to know that understands how these markets move, what drives them, all of those good things. So he spends a tremendous amount of time on every market, and then he gets into the nuances of every single market. So as you guys can see, here's the good news. If you want the full class, from April 1st through May 3rd, that's going to cost you $1,497. I've got some special bonuses for you this evening. So I think you're going to like all of that because, you get the equity and order flow and equity program. That's included in there. You're going to get, if you sign up today, now I don't want somebody coming back later. I'm going to make this like a time sensitive. You can get the indicator package, an exclusive offer to you for that. That's if you're taking the full class. And then I'm giving you an extra month. Several of you have asked about spending extra time with Ray. You'll have that. So make sure to get signed up. So you're basically saving 800 and some dollars for a 1497 investment. So I think that's very, very cheap. And here's our schedule. In the mornings, Ray comes in during the London session, puts his charts up. He provides commentary as his schedule permits. He does have obligations to the firm. Our official start time is about 8 o'clock in the morning. Ray takes a little lunch at some point, but we're talking about markets. Ray, covers things that are relevant for that day, things that he's put on Twitter, all of that stuff. Then we have a daily market training session because, like several of these folks have been saying, we've been doing this for about 5 years with Ray. So we keep going. These guys keep learning. They keep adding to. But during this class, he kind of comes back to that A to Z and he just follows everything along. So we have mornings in the markets, so you're going to be able to put context to you guys are going to be able to take content and see it live in the market with context. So I think it's super valuable. And yes, you can, Andy. Absolutely, you can start tomorrow. And the institutional training classes, those are going to be on Mondays, Tuesdays, and Thursdays at 3 o'clock. So every day about 11, we have a training session for about 1 to 2 hours. And then Mondays, Tuesdays, and Thursdays during this class period, we will have a class. And those will typically last, Ray's going to say 2 hours, but they're going to be anywhere from 2 to 4+ type hours. So 100% when Ray says that he's committed, he doesn't know how committed you are, but he's committed to getting you there. I don't think anywhere you're going to find the quality of training that Ray provides for this price, but it's not about the price, it's the value of what he delivers. You know, people have completely transformed their trading and they've put in the work, but it's 100%. While he's giving you a great value, he's not doing this obviously. He could be charging 25,000, 100,000 for this class and it would be 100% be worth it, but he's charging 1497, so it's an incredible value. And as we were showing, week one's going to be institutional order flow and equity. You can sign up for that if that's all you want to take. That's where he's going to, he's already said he'd be covering the two hypothesis trade model. He'll be covering order flow, the intern trade exercise that he gives for new interns when they come in. We'll have equities, the long volatility trades, the share buyback. You can then after that you would be able to join a Smart Alpha. I will tell you that while it sounds like it's a great value at just $50 for Smart Alpha, taking some training from Ray because you need to understand his lingo. Institutional lingo is very different than retail lingo, so giving you a heads up on that. But you can join this, and if you join the order flow only, you have the opportunity to be able to add the order flow package that you saw um, for that. So Norm, if you only want the order flow, yes, it's just 1 week. But week 2, then we're going to be moving on to fundamentals, technicals, trade strategies, institutional trade in the market matrix, understanding commercial order flow. He'll be weaving all of that, stuff in each week as he builds on it. You can take the full class for the 1497, which I also gave you the option on with the 1497 of the added bonuses. So that's a tremendous value there. Third week, we're going to be covering bonds, the curve, the outrights, the forex markets, macro elements, and he went through a lot of other stuff, market drivers, trade setups. There's specific currencies and specific markets have nuances. He covers times, structure, things that you need to be looking for to be able to trade those. And on week 4, let's see, he's gonna be covering the futures markets and the weekly inventory reports. We have a number of traders that trade crude solely. We cover the inventory each week, and then he covers all the other markets as well. He said he'd be covering the index trades. And week 5, last week, we're going to do a complete review, class summary, and institutional trade process, putting it all together, putting all the pieces of the markets together. So that's what the offer is for the full class. And, Mike was in here earlier and he was telling you, he spent a number of years. I know he spent in London, he's traded bonds, he's done other markets, he trades for himself now and private money. And he, was in here earlier saying he's been out in this retail market when he had to come from institutional to retail. He started looking out because he said he struggled a little bit going in the retail market initially, but he says he found us last summer, took Ray's class last summer, and it's really added to his probabilities and strengthened his edges. And he's quite impressed with what Ray delivers. Attention to detail, the process, getting the probabilities, knowing what his edge looks like, and accessing, I didn't get that change. It needs to be assessing the risk instead of accessing. We access it enough. So if you want the institutional order flow week by itself, then you can sign up there for that. I'll get to a page that'll give you all of these. I just wanted to get through, um, exactly, what you get if you, like right now, as Ray was saying, and a number of people have said, if you can't do the full program, take that first week. Do your trading that favor, because I will tell you, even if you work full time, even if you can't trade full time, a number of traders will tell you they've taken the full class. They've spent even a year or two going through it by themselves, but they've been able to set up, Ray really gets into the macro stuff so you can take these swing trades, for you to be able to see, when positions are building and how you want to take them with very tight stops. You no longer have to go, okay, well, I'm going to take this, but I'm going to have a really big stop to do it. You actually know. So as the bonus too, for those of you that get signed up, we have a special little area of the Ray did a class last year in August for a full week on order flow. You can have access to those recordings as a special bonus coming in early. Thank you, Wilfred. We look forward to having you. I know I was going to have to give a shout out. He's probably not in here, but literally 5 minutes into when we started, Glenn signed up. I was like, now there's somebody that's serious about this. I don't even know how he had the link. Maybe from he did the traders only. Thanks, Chrissy, very, very much. And here we have the trading suite. You guys were asking about the trading suite. This is everything that's in there. Now this is what's cool. This package is exclusive to our group. It was developed by traders within the group because, it helped them. Here's the thing you're going to learn with Ray. It's not about an indicator package. He knows how exciting it is and excited traders get for indicators, but he's going to teach you how to see it on the charts first, and your indicators, just become like your helping hand, your assistant. Because if you don't know, what ends up happening is the same thing I was talking about earlier when, you think that the indicators know something you don't. Well, they really don't know any more than you do. It becomes a 50-50, you know, casino Russian roulette game. So you're going to put yourself in a much better position by understanding what's in the market. You find what works for you, and that's how traders, really, um, are able to excel. So today's special on if you want to do the order flow and add the suite, you can save $100. You can sign up for that package, and so for $494, you can have the order flow and equity trade workshop with Ray for the full week, and then you can add the indicators. You'll get the indicator package. That's $494, saves you $100 if you do that together. But as Sean was saying last time when we did the traders only, there's no shortcuts with Ray. There's just no shortcuts to get to the pot of gold. But a lot of people, really kind of look at what Ray was talking about and they go, ooh, I don't know. That looks an awful lot like work. I think there's a really, really good quote by Thomas Edison, and he says, opportunity is missed by most people because it's dressed in overalls and looks like work. I think that's so true, when we think about Ray, because a lot of people look at it and go, oh, I don't know, gosh, he's not getting to the point, he's not talking about it, I don't, and, we start putting in all of that self-doubt. I can tell you, Ray's going to hold himself accountable to deliver you some really solid information that will transform not just your trading, but at first he's going to transform your thinking. And as Peter just said, you will not regret it. And here's the great thing for some of you guys, and I think this is super, super important. Here's a slide here that's going to show you all three of the programs. So you can sign up for the full program, which is April 1st through May 3rd. And you can sign up for that for $1,497. Plus you get those bonuses today. You can sign up and get, if you just like go, you know what, right now that's not what I'm interested in, I just don't know. You can sign up for the order flow and equity trade program with the indicator suite, or you can sign up for the order flow class by itself if you don't want the indicator package. A number of you have asked. The indicator package is only available currently on Sierra Chart. But I think Norm asks a very important question. Like Ray almost didn't let the group introduce the indicator package because Ray doesn't really, he wants you guys knowing the information, because otherwise he just feels like you're going to take trades and you're going to say, oh, this doesn't work. The indicator package is an order flow package, Ted. I'll go back and show you guys what was offered in that. And guys, for those of you asking, I will sit here and answer all of the questions. Here's what's in the order flow suite, Ted. You've got auction bars, you've got momentum, exhaustion, volume, and Ray's going to teach strategies that, fit with everything that's being here, stopping volume. One of the main things people a lot use is the measured moves. Some of you guys were asking, hey, how are we going to know how to get out of trades? I think that's, one of the really valuable before she goes. I think that's an amazing trade because Ray's going to teach you from fading the markets. So He's going to teach you squeezes and all of those things in there as well. And I will say I concur with what Tracy is saying. Traders really, really like Sierra charts. And the one thing that I didn't say in here, for those of you that take the full class, now this just goes for the folks that take the full class, is, Ian that was in here earlier, they have a full self-help group and they provide tremendous amount of support to help each other. That's what has been so valuable about this group is it's not just Ray and him uh, you know, teaching. He gives you so many different ways to look at the market. You're going to find what works for you. And the thing that's been important that I've seen and is such brilliance over the years, I don't see any two traders doing the same thing. And you might look at that and say, ooh, I don't know about that. I'm wanting some real set rules and structure. Well, you're going to hear those, but you're also going to be able to fit, you know, what really actually fits for you, the time you have available, your account size, what interests you. These are all things that I don't think get talked about out in the market that actually play into you having success as a trader. And as Andy's saying, if you are serious, I think a number of guys are going to say this, if you're really serious about being a trader and making consistent money, you need Ray and this course. I agree, Andy. It's so true. Oh, and Dawn, thank you for asking that. After you can continue your training, you'll have access to an incredible library inside the members area. But if you want to continue in the live sessions and you want to continue with your daily learning, you can do that with a full subscription for $250. The great thing about that, like we have a number of students right now that'll come in, they'll activate their subscription during this class so that they can take the class again. And during that, then they'll have access to all of those recordings. They're available on demand. So it's an incredible value. You can add Smart Alpha, which is $50 a month. And Ray posts incredible tweets on there. But I would like to warn, while he posts a lot of tweets, the best value is for you to have an understanding from Ray. So even if you are thinking, well, that's just what I want. I want those, um, share buyback, the repo trades. I want the long volatility trades. Take the order flow and equity class for $297 and then add Smart Alpha for $50, and it's going to be an incredible value for your trading. Oh, Ashok, I'm so sorry I didn't see your question. No, this suite only works currently on Sierra charts. And if Jerry's saying if you're on the face, I'm thinking he's meaning on the fence. And he's saying do it. Okay, so no. So here, I'm going to go back to that, Will, because I know you signed up. So here, let me make sure that everybody's really clear because we do provide a lot. This really is an institutional type program. You're going to be these are all of this is in one room. So in the mornings, we're in there. In the morning, we just have our morning trade session. Ray's talking about the markets. People are asking him different things that they're seeing on their charts. He's giving, things that are putting context to stuff that, content that he's delivered. So that's what our morning session is. He comes in during London, puts up his charts, he provides commentary as his schedule permits. We start our morning session. Then around 11 Eastern, we do a daily training session. During the month that we're doing the class, those training sessions will match and fall in line with whatever markets he happens to be talking about or what he's talking. So he ties those in on Mondays, Tuesdays, and Thursdays. We'll have an additional class, which will be your actual class for Mondays, Tuesdays, and Thursdays. You'll have an added class. And as Peter says, the specifics of everything will be revealed. He gives all of it. So for $1,497 for an entire month to spend live in the room, to have training sessions, to have trading classes, to also we're giving you additional early bird access, which you guys have no idea the value of the early bird access. So if you sign up right now for the early bird full class, you'll get access to the trade rooms. You'll get access to the members area. You can start your training. And there's a few guys that have already come in and they're already saying how valuable that is, because then by the time the first gets here, they're going to already have their charting package set up. They're going to have been able to go through last August. We started a class. So they've started going through some of those classes. So they're ready to go when Ray is, because as you can tell, you know, Ray likes to go at a clip. Norm, so if you sign up for the 1 week, you will have access that week. You will not have early access. You will have access that week, absolutely. And um, I did mention how great our group is. And that's the one thing that I was saying. Everyone is so generous with their time, with their help, helping each other. I think it's phenomenal. Our group is amazing. Oh, Norm, absolutely not. You will keep access to the recordings, the order flow recordings. Yes, you won't have access to others, but you'll have access to the order flow sessions. Absolutely. That's super, super valuable. Yeah, Andy, that's what I was saying. I'm just doing this special as a special, like Andy's saying. We paid, years ago when we were doing this. I think at one point we had our class, it's probably 1997. I think it included a couple months. I don't know that we'd ever had any bonuses. I'm wanting to, the one thing like Andy's saying, even if you paid twice this or 3 times this, it's still an incredible value. I know a number of guys out there that are selling, like, they're for less than what we're that Ray's delivering for like 7,500, 10,000. There's a guy that does a class for 25,000, and I assure you what Ray's delivering is going to be at a much have much better value and outcome. And let's see, make sure I'm getting all the questions. I think I'm missing some. Yeah, if oh, Val, very good question. Yes, so if you sign up tonight, you'll have on-demand access to all of the members area. And then when you're done, you'll have access to your class, to your order flow, and you'll have the one thing that people don't get going forward, if they pay the subscription, they get the active sessions because Ray continues to teach them. But as Peter's saying, you absolutely are not going to want to cut it short, because Ray is phenomenal. We're addicted to Ray. Let's just be honest. He's phenomenal. And here's the thing that you're going to find about yourself, not just about the markets, but just his approach, his work ethic, I mean, you'll find yourself wanting to raise your game in all aspects, because you're going to think like, ooh, what would Ray do? Well, he's going to hold him what he wouldn't do. Think like, ooh, what would Ray do? Well, he's going to hold him what he wouldn't do is he will hold himself accountable. He doesn't make excuses. and he delivers. He way, way, way over delivers. We always laugh because he apologizes every time. Or he'll say, "Sorry guys, I went a little too long," and we're always like, "Hey, we can go another hour or two." You're never going to get shortchanged with Ray, but his passion for the markets is infectious. His thirst for knowledge, and you'll quickly learn how much he appreciates, what as retail traders, and how he delivers and delivers and delivers to get you there. Sometimes he'll give the same message with a little different twist just because he can tell like that we're not getting there. But I highly recommend, if you're coming in, make sure that you come in with the attitude to participate, not to sit back and be quiet thinking that you might embarrass yourself, because Ray knows that we don't know these markets like he does, and he wants the interaction because, more importantly, it's not about you giving him money, I assure you. It's about you getting it and having results. He almost didn't continue after the first month or two. I guess it was after the second class, because he was worried that what he was teaching wouldn't have that he couldn't deliver it in a way that it could have an impact for the group. And for him, it's not about the money. If it was about the money, then we would, be out doing these classes all the time. This is only the third class that we've had in about 3.5 years. So this isn't something that he does often. In fact, us having another class within the same year is pretty remarkable. He hates webinars, absolutely hates to have to do them, but he loves teaching and he loves the traders having success. Nothing makes him happier when we get those emails or people in the room. And he can tell by the narratives. Earlier, I talked about how important it was to be able to think like an institution and have that. I thought I better get this up there so you guys, if there's anything you guys want to see, just tell me and I'll put it there. But you can sign up for the full class, compassfx.com/sharp trade. You can sign up for the order flow week equity trade program with the indicators, 494 at compassfx.com OFS for order flow suite. You can get that. And just if you want just the order flow and the equity trade program, it's 297. That's compassfx.com/sharp6. Am I missing anything? For some reason, my chat is not. Oh, Norm, did you ask me about something? Just signed up for the full class. Thank you so much. Hey, Jason, how are you? Jason took is one of the, I think you took the recent class last August. He's a younger guy, works full time, has a family. He can tell you he's really made some sacrifices because he felt this was such an important um, program to help him with his trading. Absolutely, Val. We will get you now. Our guy to give you access to the members area will be in the morning. So, guys, for those of you that get signed up tonight, we'll get you all access. You can have access to the room. We can probably get you access to the room tonight. We'll probably get the members areas all done in the morning. I know there's been a number of you, and we 100% appreciate it. Ray's phenomenal. This will be an amazing decision that you've made. As Jason says, best class in education he's ever had, worth every penny. He has done the class, and he's also spent time, paid for a subscription at different times when he can take time off of work. He does that, for the education for himself. And let's see. So Ashok 494, that is for the order flow um, class for that week, and it also includes the indicator suite. Yes. Confi, we do not offer just the trading room, and the reason being is because you absolutely would not have an understanding. And I will tell you, from truth, initially that was what Ray wanted to do was just have a trade room, right? And so that first week back 5 years ago, we held a session. Um, in the markets, and Ray, after the first day, nobody knew what he was talking about. We didn't know he didn't understand us. We didn't understand him. And he literally was almost like, no, no, I'm not going to deal in this market. And I said, really, we need to do a class. And so from that going forward, we realized, there's such a big divide between the institutional world and the retail space. So it did require, with his knowledge, for us to be able to do a class so that, because he doesn't want to waste his time and he doesn't want to waste your money. And that's how he feels that just doing a trade room, that was kind of the road. Um, Hey, Stephen, how are you? Let's see. I didn't see. Again, does the institutional order flow and the workshop teach the two lines? Yes, that was what he was talking about, Norm, the two hypothesis trade model, right? He said that would be taught during that week. I did hear him say that earlier. So he said he would be teaching the two hypothesis trade model. We'll have order flow and the equity trade. Thank you, Stephen. And C, absolutely. That's the great thing about signing up now. And Stephen's one that signed up. He can tell you being able to have access and get started early is, you know, when we talk about how much you're saving on the others, well, that part is priceless. Having extra time with Ray, that's, going to give you such an edge when he gets started. So Clark, thank you for that question. So with the 494, you're going to get the week. So you will have an entire week in the room with Ray, and you'll get the order flow suite. You will have on-demand access to those recordings as well. What you would not be able to do would be able to add a subscription after. HKP, we've had those, we have sessions that go back a couple years and they're still in there several years since we opened up our members area, I think was back in 2015 or so. So we certainly haven't limited things. The indicator suite is a one-time fee. If there is the additional part, Ashok, on the, if you want, I will show you which part. Let's see, let me get back to the, sorry guys, on here. If the market maker and the yields package, it requires a separate subscription because you need the data. I think it's about $30 a month or something like that. So if you're wanting those two things, that's not through us, that's through David for this package. But he's been providing, now, if he does add some additional indicators or whatever at different times, he may, um, have a charge. I will tell you this order flow package alone, if you were to go, you couldn't even get it out on the market because stuff in here is built around what Ray teaches. That's what, like there's stuff that in here that you can't even get out on the market. So there's things that he does to upgrade. He's done this at such an incredible, fee at 297 for the group. It's pretty amazing. And as Tracy's saying on Sierra charts is you get a discount, but on the market maker and the yields package is a separate subscription on top of Sierra charts. So hopefully that makes sense there. But a number of you guys have gotten signed up. We look forward to working with you. Absolutely. Hey, we will see you in a couple weeks. Now, having said that, we will make your access to the room where you can come in, and we will let you. I will let you guys know in here. It's absolutely personal preference, and the reason I say that, for some people, doing going through and starting the other recordings is perfect for them, but sitting in the room gets them confusing. I think being 2 weeks out, I think spending time with Ray, getting to know him is going to really get you in kind of the flow. It's kind of like the build up to to sign, like the drills like they have the two-a-days for football, kind of get you ready. And yes, absolutely, Val, you'll have access to the members area where you can get started. Absolutely. And we're here for you too. And Dawn, to sign up, if you want the full class, that's the compassfx.com/sharp trade, the order flow and equity trade program with the indicator suite is $494, and that's compassfx.com/OFS. That gives you the 1 week in the room. That doesn't give you any early access into the room, only just that week. And then you could do just the order flow by itself. So absolutely. And Mike's asking a great question. I see, Mike, I see you're um, asking for a friend. Absolutely. If you can hear me, yeah. So for the order flow only, they can do the order flow week. Now if you're asking about like when he does the e-mini stuff later that he covers on that, they would need the full class, but you can do the order flow, which you know what he's going to cover during that. But perfect, we'd love to have you. Oh, thank you so much, Dawn, for asking such great questions. You can get the additional months in the room you can do a all access for $250, or you can do recordings only for $125. But if you get signed up tonight, for those of you guys that are signing up tonight, which is phenomenal, because look at everything that you're getting. Look at this, which a number of you guys have. You guys are recognizing value, and I want you, let's see, where? Sorry, I should have known where these were so I could go. But right here, the extra bonus that you're getting is the order flow, the indicator suite, and you're getting an extra month. So you're getting an extra like 250. So right there, even if you take out like the institutional, that part, you're still over $500 savings. Because you probably would be adding the indicator package, and you more than likely, that's why I'm saying this bonus is tonight, or I'm going to put a time limit on it. I know some people didn't get to be in here tonight, but if you get it tonight, we're going to get you going. We're going to get you set up. We want to, fill up this class. We want you to tell your friends. So if you get signed up, yes, you can be live in the morning for some of you asking. You can sit in with Ray in the morning. Oh, I'm sorry, Ted. My name's Kim. How rude of me. I think I probably said it. If you weren't there at uh, the first 10 seconds, we probably missed it. But I'm Kim. Like I said, we've been working with Ray for the past 5 years. And when he wanted to join us, or actually, he really wasn't even looking to join us. He was wanting, as Compass, for us to, he was providing market commentary and analysis and stuff because of his background to, the banks. He thought, well, you know what? What if he provided it to groups like Compass and then we could in turn sell it out, to our users? But we didn't know what he was talking about. So hence, that's how this all came to be. Let's see, Ted, we'll check. Did you just order? Tracy's going to check for you. I haven't seen, I've been seeing quite a few orders come in, but I haven't been able to look at them all. And guys, I'm going to real quick, just so I'm saying a welcome and make sure to get signed up for the bonus. Um, Real quick, I'm going to go back to this right here so you guys can see. Sign up for the ultimate class, compassfx.com/sharp trade. Then you've got the indicator package.com OFS / and then sharp 6, because I'm going to stop the recording because we've been in here for several hours. So thank you guys for being in here. I'm going to continue answering questions, but I am going to stop this recording. I forgot that I still had it rolling. Make sure you sign up. Come join us.